As a former governor of Rhode Island, very aware of the allocation of a $6 trillion budget and what it means for the states, because trust me, Rhode Island's got some infrastructure challenges as well. I do want to note we're following HSBC this morning, the chairman and the CEO speaking in statements, and it's ebbing away a little bit. You know, I don't want to make too much of this, but it's pulling back. And again, this is off the bombshell announcement. After 40 years, HSBC will exit retail in the United States and focus on wealth management. What a shock they wander over to Asia. We'll do that here in a bit. Right now, Emily Wilkins in Washington. With us, Lisa Abramowitz and Matt Miller in Berlin as well. Emily Wilkins, it's real simple. I believe the president proposes and Congress disposes. Is there anybody in Congress that wants to dispose towards a $6 trillion budget, and particularly anyone in leadership?
I think Republicans certainly are not going to be big fans of the budget that is coming, particularly with their concerns about the rising deficit and the amount that this bill would add to it. But you know what? A lot of the additional $6 trillion that we're seeing in this bill, it's already been proposed in the infrastructure plan. We knew to a certain degree that this big number was coming. But Tom, you're absolutely right. You know, this is half suggestion, half wish list on the part of the White House. Congress just looks at it, they nod at it. I mean, at least Biden's got his party running the House and the Senate, so that's going to help him a little. But always changes to this document.
Yeah, Lisa's been up since 1 a.m. lining up her fiscal questions here. So, Lisa, why don't you jump in here with something more intelligent than me?
Emily, there is a question of what will get excised, what will be potentially a non-negotiable addition to his spending, and what won't. Goldman Sachs sees it coming down to $3 trillion. What are the parts of this bill that are expected to be permanent?
So I think the parts, a lot of this bill, of course, it's stuff, programs that have already been enacted, programs that have been authorized, programs that have already been spent. And then what we're really seeing this last week is sort of that consolidation around that traditional infrastructure spending, the acknowledgement that, yes, we do need to spend more on America's roads, bridges, highways, public transportation. Democrats are going to continue to push to get climate change initiatives in there, things for electric cars and electric vehicles. And there's also a really strong push for child care. The head of the powerful House Appropriations Committee, Rosa DeLauro, that is a top priority of hers. And I mean, she's the one who controls this process in the House, and she really wants to make sure that that is a part of a final piece of legislation.
Emily, how concerned is any part of the Democratic Party about the U.S. deficit?
I think it's something that everyone's watching at this point. I mean, obviously the numbers that came out in April were not great for Democrats. You know, you saw a sluggish return to employment. You saw increased inflation. Yesterday we heard Treasury Secretary Janet Yellen come out and say, look, inflation might be a little higher for the next couple months, but after that we expect it to normalize and go back down. So I think it's a big question of what does happen. What are the numbers? Because the higher these numbers go, the slower the recovery becomes, the harder it's going to be for Democrats to say, you know, this is based on other factors rather than spending.
And man, what's so interesting here in America is the basic idea of a Trump budget with estimates of economic growth versus a Biden budget with estimates of economic growth. It is Venus and Mars.
Well, I mean, the importance of that can't be cast aside, right? Because it's typical for someone in the other party to say economic growth is going to pay for this. We don't need taxes. Whereas the Democrats are going to say, let's raise taxes to try and pay for this. And they want to do that in a pretty major way. I think that's going to be the big debate, Emily. How likely is Biden to get his tax proposals through?
If they decide to go through only Democrats, then there is a likelihood that they could find a way to negotiate and reach an agreement. Certainly won't be as much as President Biden has proposed, but it could still get done. Of course, if they want to go forward with Republicans, they've already made it clear that raising corporate taxes, doubling capital gains, those are not options that are on the table. They're looking at public-private partnerships, bolstering the IRS's capacity to audit. But at this point, that's still a major sticking point, and there's really not an agreement at this point on how exactly things would be paid for.
What is he likely to get in terms of corporate taxes? I mean, maybe he won't be able to raise it to the level that he wants, but surely they can make some compromise.
So the major indicator, as always, is West Virginia Senator Joe Manchin, one of the most moderate Democrats in the Senate. He has said that he's interested in 25%. I've also spoken to a number of moderates in the House who are like, look, the White House needs to show report in November.
Emily, thank you so much. Emily Wilkins with Bloomberg Government in Washington. We've got to take a moment here. I mean, it's a precious moment, but we really need to take advantage that Matthew Miller is, as we describe, Bitcoin. I look, Matt, help me here. I mean, Lisa and I are like, we don't want to talk about this, but Matthew Miller is with us. So, Lisa, here we go. Matt, I'm looking at Bitcoin south off of the Bank of Japan comments, the recent volatility, maybe 8, 9, 10 days ago. And what I see is 2 standard deviations south is 29,000, 28,800. How critical is it for Bitcoin to find that support and keep it?
Well, I'm not a technical analyst, so I don't know about those numbers, but I will say, Tom, that I got a lot of messages from Bitcoin enthusiasts as soon as we saw this $6 trillion number. That's the catalyst for them to say, maybe this is another reason to buy Bitcoin. And I'll remind you that when we first started talking about Bitcoin, I was out there buying them for $600 a piece.
Wait, you have a lot of Bitcoin?
Even 36,000.
Here we go.
Even 36,000 doesn't look too low.
Literally, this is Matt's victory lap. Is that what this is turning into? He said, I remember when I bought these at the very bottom, and now I'm buying my H1 Hummer for free, basically.
H2,
If I could remember the password, I would buy us all Hummers.
This is getting the H2 Hummer, folks. It's the one with the 23-gallon capacity.
I don't really understand why Bitcoin would sell off at the Bank of Japan comments. The idea that the Bank of Japan is coming out on top of all of the other central bankers saying that Bitcoin looks speculative. Of course they don't like it. That hasn't stopped any of the enthusiasts until now. In fact, has been part of the whole point of it, Tom, is that it goes against the common fiat currency that people rely on.
But Matt, this is really important. It seems like the intrusion of government authorities and government institutions into Bitcoin causes a price decline. Are you and others waiting for like the big statement from Secretary Yellen, something like that?
I think they're definitely waiting. Others are waiting for regulators to embrace this. Some regulators, doesn't have to be a U.S. regulator, but maybe a G7 regulator to say, we're okay with this. So, you know, I'm personally more on the libertarian side of this.
I'm shocked about this. The guy moves to Berlin. All coming up, folks, Matthew Miller on Austrian economics. What do we know for certain here? Futures up 15. Bill Priest is going to join us. He's going to walk off the set if we talk about Bitcoin. On cash flow, Bill Priest. Good morning. On cash flow, Bill Priest. Good morning.
PSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelson, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit pso.org/now, where the music...
Hello, trader. Sorry. Hello, traders. Are you ready to trade euro? Wow, it's looked down. We was looking to sell short right now euro at 121.90. Let's see if it will go up, because if it will move down, there's not much point to place an order to sell short. Let's see. Hold on, guys. Let's see how it's going to react on this news. As I can see, quite a few brokerage firms copy our trades, because we noticed for at least for 6-9 months the order we place get filled before we get filled, and sometimes we placed an order that quite easy to get filled. No, the order to sell short, so as you can see from this your screen, canceled because it moved fast and it moved down. Let's see and let's wait for another chance. Sorry guys, wrong message. We're not looking to sell right now. We need to see what's going to happen later on. In the meantime, as you can see, we're moving up to Japanese yen, and soon we probably will place stop on profit for Japanese yen. Okay guys, I'll speak to you later. Stay safe.
Isn't the ultimate issue that each portion of Germany is controlled by a separate politician that doesn't want to see their Bundesbank taken away? So there's going to be natural opposition to any kind of consolidation whatsoever. And isn't that the ultimate issue?
That's the problem in the German market for sure. You've got a really fractious German banking market. There are hundreds, if not thousands, of little Sparkassen dotted around the country.
What did you say? You can't say that on radio.
Excuse me, Gesundheit.
Sparkasse. That's why, Tom, you know, we were talking the other day about, is JP Morgan coming into this market? Is Bank America coming into this market? And the consumer banking market is just too unattractive in Germany because there's so many players already here.
That's going to be interesting to see, and something that goes through the summer with the reset. Here's HSBC speaking today. On a Friday on Memorial Day, we reset for the summer. Maybe we reset for new habits. What you need to know is there's one book on this, on use of cash, on free cash flow. You know I love Peter Bernstein's classic, Against the Gods. I speak of Megan Desai, the economist at London School of Economics. This is the definitive book on cash flow. It is by William Priest. He's at Epic Investments. He actually runs real money, but what he's actually done along 13 years ago is write the absolute definitive book on free cash flow and shareholder yield. There's no other way to put it. Bill Priest, if you wrote free cash flow today, would you write it differently?
No, I would write it the same way. I would make it slightly more flexible, in the sense that when we wrote that book, 10-year treasuries were yielding 4%. And today, obviously, they're yielding a lot less. So the yield requirement that you might have in an income-oriented portfolio should be more of a floating yield requirement than an absolute yield requirement. That said, it still worked pretty well over a long period of time.
Well, this is really important, folks, because we're at the zero bound. Like if I take the Sharpe ratio, Bill Priest, I've taken beta out of it, but I still have a risk-free return, which I can't really calculate right now. How do you plug in a risk-free rate when you go through the fancy math of your fancy book?
I don't think the math is too fancy. The key to the shareholder yield book has to do with the growth rate and the average and the weighted average cost of capital. The growth rate has to be equal to or greater than your cost of capital. Otherwise, you're liquidating your business. So the key is to emphasize the reinvestment rate as much as the yield itself. So the yield itself, without a gap between the reinvestment of incremental capital and the incremental cost of capital, that has to be widening over time. Otherwise, that free cash flow yield as an absolute measurement will not work as well today.
From your years being the chair and CEO of Credit Suisse Asset Management, there is a question to your position today as head of Epoch, the idea of head of investments there. Has the idea of risk changed given how low yields are?
Well, risk is really uncertainty. So the way it manifests itself today is in the duration of assets itself. So to the extent you have, when interest rates fall, long duration assets benefit the most. So these entities that have very little or very short-term cash flow yields, let's say, but if they have great growth rates associated with it, they do extremely well. Think of it in a bond. The 30-year bond moves the most with a given change in rates if rates go up or down. The 10-year moves up, but not like the 30, and the 2-year moves also, but not like the 10 or the 30. The same thing's true in equities. So a short duration equity will move very little relative to a long duration equity. So think of some of these growth stocks or some of these tech stocks where the payoffs are way down the road. When interest rates fall, the present value of that long payoff actually rises quite a bit, but the reverse is true. And I think what you're seeing in the market right now, there's a combination of these reopening trades, which is certainly happening, combined with a fear that inflation is going to grab a hold of that yield curve and start to shift it up.
So
we haven't seen much of it yet, but the fear is out there.
This is fascinating to me because in some ways the risk right now, as far as people see it, really lies in the safest assets, the assets perceived as the most reliable, government debt, the assets with most duration, which raises a question, do you then go into the riskiest assets like Bitcoin, for example? You even have the likes of BlackRock saying that they are speculating or they're examining whether to look at Bitcoin as some sort of commodity-like ballast going forward for investments. Do you agree?
Well, let's step back. I'll answer the question, but I'll step back. What is the role of money in any society? Money does three things. It's a unit of account. It's how we decide what we buy. Instead of barter, we have a medium of exchange. So it's a unit of account, a medium of exchange, and a store of value. Now, digital currencies, particularly with Bitcoin or Ethereum or all that stuff, they meet 2 out of 3. They can be a medium of exchange. They can be a unit of account. But in my view, they are not a store of value. But coming down the road, these central bank digital currencies, this is the real deal. This is coming. And the issue is largely going to be around privacy. That's where the rub is going to be. So we've never been big fans of any of the Bitcoins, the digital currencies. But the central banks, they are coming into it. China will probably be the first. I think you'll see something in Europe and the U.S. The verbalization of what they're doing is behind the curve, but they will get there. If one really wants to learn about digital currencies and central banks, the Bank for International Settlements has a very long paper, 150, 200 pages. I read it, well, I don't know, more than a year ago. That is a necessary read if you really want to understand what's coming down the pike in digital currencies, particularly with central banks.
I mean, if you separate the tokens from the software, Bill, we saw just a few weeks ago the European Investment Bank sell 100 million euros of digital bonds on the Ethereum platform. That doesn't mean you necessarily want to buy Ether, but it shows you the value of the platform. Bitcoin, on the other hand, has at least a limited supply. Doesn't that make it a store of value?
It fluctuates. The store of value fluctuates quite a bit. It's unclear to me that you're going to be able to maintain a store of value in Bitcoin. It's often been played off against gold. Gold's had a rally recently of substance vis-a-vis these digital coins. I think the real issue in digital coins is going to ultimately be privacy. Most of the uses to me, from what I've been able to read or observe of these digital coins, have often been for illegal activities or, let's say, untaxable activities. They may not be illegal, but it's a way to avoid taxation.
Right.
If you went back a year when we had the CARES Act, if the CARES Act was delivered, if the monies associated with the CARES Act could have been delivered through a digital currency with the identification surrounding that, on the one hand, I think it would have been much more efficient. A lot of that money went to people who shouldn't have gotten it, but some of it went to the right places. But I think you could have gotten all of it to the right places. The problem is there's a privacy issue here. And I think that gets back to this whole issue of surveillance capitalism. And Shoshana, I forget her last name, Zuboff, I think it is. Shoshana Zuboff has written a book about this. She's a professor at Harvard. it's a must read, and I would really encourage Tom to get her on his show. She's first rate, and this gets into even bigger issues, which really have to do with what I think is Cold War 2.0. And for Barron's, I wrote a piece more than a year ago about Cold War 2.0, and it's about values. China's about social scoring. If you have a high social score in China, as Chairman Xi has said, you can go anywhere you want. You have a low social score, you won't be able to go out your front door. That's one set of values. On our side, we have Bill of Rights. So embedded in all this has to do with what's going on in the digital world today. All the privacy issues.
Bill, we did all this digital stuff. We didn't even talk about use of cash, Apple, and the rest of it. We'll do that again soon. Bill Priest with us on free cash flow. We need to make note, Lisa, of something you and I avoid like the plague. I think John would be in agreement. And that is what we're seeing in one massive short squeeze. If you look at AMC, and up it went, what, 4 months ago, 5 months ago? It has blown through that in the last few days, and far more importantly, has blown through that this morning, moving out from 28 to 32 off the top of the chart on AMC. I mean, there it is once again, Lisa, GameStop, AMC, and a big small cap short squeeze.
Yeah, it's the revenge of the meme traders. And there's a question going forward of how much this has legs, of whether you could short sell some of these companies based on fundamentals, or if you're just going to get your head ripped off by those traders on Reddit, Tom. It really raises a question, though. How do you measure risk in this type of market? How do you really evaluate fundamentals when you have that kind of mass coming against you?
Let's go cultural here, because Abramowitz's offspring are on the couch. My kids are on the couch. Afterthoughts, like 4 hours. Day trading Apple yesterday. Matt Miller, are kids in Germany on the couch?
There is, a much more difficult day trading situation here. My daughter has tried to get it up on her iPhone, and she just can't do it. There's too many rules and regulations. We don't have the same kind of Robinhood.
Can your daughter walk yet?
No, she's only 7.
Okay, I was about to say.
But she can use an iPhone. She can use an iPhone already.
Yeah, she's not trading Reddit shares, though, I will say. Stocks that are discussed on Reddit. I will say, though, my kids, who have been absolutely schooled in Roblox this year, really, really educational year, are really into Dogecoin. So there you go.
Chicago potential there as well. It's going to be interesting to see. We make jokes about it, folks, but I want to make clear, Matt Miller way out front on the ascent of BitDog a few number of years ago. Futures up 15, Dow futures up 169. Edward Morris of Citigroup will stop by. Dean Kernett as well on the VIX. Stay with us from New York, from Berlin. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Russian hackers behind the SolarWinds campaign have escalated their attacks on U.S. federal agencies, think tanks, and non-governmental organizations. That's according to a blog post from Microsoft Vice President Tom Burt. In April, President Biden ordered sanctions against 32 Russian individuals and entities, including 6 companies that provide support to the Kremlin's hacking operations. In Taiwan, officials say the coronavirus outbreak is still not under control, despite strict social distancing measures. The island's death toll surged by almost a third in the past week, and authorities reported hundreds of new infections. Taiwan's health minister said today he hopes 60% of the population can get at least 1 dose of a COVID-19 vaccine before the end of October. Japanese Prime Minister Yoshihide Suga is extending a state of emergency for Tokyo and other major cities. It's a last-ditch effort to rein in COVID infections ahead of the Summer Olympics in less than 2 months. Many Japanese citizens are worried the global sports spectacle could turn into a super spreader event. Japan has one of the slowest vaccination programs in the developed world. And Nike says it's extended its partnership with Neymar over the Brazilian soccer star's refusal to cooperate with an investigation into the claims that he sexually assaulted a company employee in 2016. The sportswear giant cut ties with Neymar last August, but didn't say why publicly. The athlete says the allegations are baseless. The Wall Street Journal says that there were 8 years left on Nike's marketing contract with Neymar. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public.
Day traders, all of you who decided to buy Japanese yen, it's time to play stop and profit. The price you need to play stop and profit on 109.06. 109, let me show you where. 109.906. Okay, so we play stop and profit. So whatever happened, you will not lose any money. Why do you have to play stop loss? I don't understand why. For years some advisors, some people who been in the industry for years, trying to advise you play stop loss, what they even call it. Yeah, okay, stop and profit plays. Whatever happened, you will not lose any money. In our case, we will have a profit if it will change direction, 200 pounds, because every 1 pip equals 100 pounds in our case. In your case, before you enter trade, you had to decide how much you want to spend money on this trade. So how much broker pays you per pip. If you don't know your money management, if you try to learn this kind of stuff, get the strategy. It's all there, and you will find all information. We will teach you how to trade profitably, because we've been trading since late 90s, and we've been using this strategy for very, very long time. I'll speak to you later, guys. Stay safe and good luck. Maybe if you know some other pairs, you can trade. You can use this strategy to use other pairs. Okay? Stay safe.
Members are not vaccinated, then maybe you have a few more worries heading into the fall. But I don't think we're ever going to go back to those hideous numbers that we saw last winter. That's really thanks to the vaccines.
Jennifer Nuzzo, Johns Hopkins Center for Health Security. And what's interesting into the Memorial Day weekend is the domestic debate over vaccinated and unvaccinated. That debate, no doubt, will continue into the summer. The new debate, or rekindling of the debate, is a discussion of how did this begin? Where did it come from? And Lisa, it's really come up in the last number of days on the lab leak theory.
Yeah, that theory that was rejected initially as conspiracy theory or just hearsay is increasingly gaining some credence. The U.S. is examining some intelligence that has not yet been released regarding this. And there is a question of how much this is significant and how much this could change the conversation around the coronavirus pandemic. Andrew Pekosh has the actual science behind it, which will be helpful in framing our understanding of it. Johns Hopkins Bloomberg School of Public Health professor and virologist. Andy, is your sense that there is plausible proof behind this theory that the coronavirus, COVID-19, did originate in a Wuhan Chinese laboratory?
Well, I think the important thing to understand here first is we want to differentiate where the pandemic started from versus the process that got this virus into humans. So I think it's clear that this is not a virus that has been engineered in any way by humans. It seems to be a natural isolate. And we think that the way it became a human pathogen is because it went from bats into animals and then from animals into humans. And I think what the debate right now is about is that last step. Did that last step happen because of a person coming into contact with one of these intermediate animals and that launched the pandemic? Or is it a situation where a laboratory was working with this under unsafe conditions, there was some sort of a lab leak, and that caused the pandemic? You know, working on these viruses for over 20 years, I can tell you that the safety precautions that have to be put in place are really quite high. And so the likelihood of a lab release is really very, very, very low. However, as you've mentioned, there does seem to be some movement on the political side today and talk about information that hasn't been released yet, which is, I think, the big question mark right now.
Andrew Vetbill emails in. He's watching the show this morning. Good to see that the dog is watching the show. Andrew Pekos, everyone listening with pets, including Francine Lacroix, can it go the other way? If we get COVID, can we give it to our pets, or for that matter, to animals of the agricultural persuasion?
Yeah, excellent question. There is evidence that companion pets, cats and dogs, can be infected with SARS-CoV-2, and that's probably a result of their owners being infected. There's not much evidence of the virus moving in the other direction. So that's, I think, one good thing. When it comes to animals, I think we've seen that there are a number of animals that can be susceptible to infection. We haven't seen huge outbreaks in those populations, but those are populations that we have to worry about. The mink farms in Europe and here in the U.S. were one example of that. And I think we have to pay attention to those kind of things, because anytime this virus enters another host, that gives it a whole new area to adapt, and the virus that comes out of those hosts may or may not be better at infecting humans.
Andy, it makes sense that coronavirus that started at a market in Wuhan might have come from the coronavirus lab down the street in Wuhan. And it's also understandable why you wouldn't want to immediately discuss that. I mean, politically, it's difficult for China, and there's no reason to rock the boat. How important is it to scientists to find out where this virus came from?
Oh, it is absolutely critically important. And that's why I think you're hearing some scientists saying, when we approach this issue, we want everything on the table, because we don't want to rule something out for political reasons or because we don't want that to be the reason the virus emerged. I'm simply saying that the critical thing here is going to be understanding how that virus went from bats into some other animal and into humans. And that's going to tell us something about the pathway in which viruses can enter the human populations, and that's going to help us prepare better for the next pandemic if we can find ways to limit that exposure. Again, if it happened through a laboratory, then that's something we also have to understand. But even if that was the case, it was probably adapting before that to infect humans, and so we need to go even deeper than that to understand how the ecology of this virus resulted in something that can cause such a tremendous pandemic.
Dr. Pekos, as we head into this Memorial Day weekend, a lot of people are saying if they've been vaccinated, they don't have to wear masks. They can be with other individuals without worrying about getting sick or infecting others. Is the risk of getting ill or possibly fostering some sort of additional variations pretty much off the table if you have been vaccinated at this point?
I would say that if you're vaccinated, you certainly are protected to a great degree. We've had some tremendous data coming out, especially over the last 4 to 5 months, that shows how good the vaccine is working at preventing severe disease, at preventing symptomatic disease, and even at preventing transmission. Now, nothing is 100%. And what I really worry about is the 40 to 50% of the population that isn't vaccinated right now. We're in a situation right now in the summer that the virus is not spreading as efficiently as it did in the fall and winter when people were inside. So I don't want people to get a false sense of how low the infection rate is, because we're seeing a combination of vaccination and poor transmission conditions driving these low rates. Come the fall, we may see another surge of cases. Probably won't be as severe as they were last fall and winter, but we will see a surge of cases if we don't get more people vaccinated.
Andrew, very valuable, particularly there on the beasts of surveillance. Andrew Pekos with Johns Hopkins, Bloomberg School of Public Health, a professor, and of course, one of the nation's great virologists as well. You know, I think, Lisa, the emotion of having pets, and John Farrow has Gunnar Nordahl. He calls him Nordahl or Nord. His dog, he is named after the great star of AC Milan as well. And then Matt Miller, you've got the beast over in Germany.
I've got Steve over here. He just turned 10 years old. I'm not worried about him giving me coronavirus, but, you know, we had a big take story the other day on Silicon Valley working to extend the lives of dogs. And I think Rottweilers typically only live 20 or 30 years. So I'm hoping we can put some of that science to work with little Steven.
Tom, this is all just a big ploy to put adorable dogs up on the screen right now.
I think this is a ploy that the Abramowitz kids are watching, and the offspring are going to go, mommy, mommy, mommy,
Oh,
mommy.
really? Really? You're going to get on that train? Can I tell you, I can't deal with a dog also. It's just too much work.
Mommy.
Oh, I know.
All you care about is your job. Get us a dog. And that's where.
Wait, are you channeling? Do you have a camera in my home?
No, I just think, I think, Matt, you got to agree the Abramowitz clan needs one or even a brace.
Absolutely.
A brace of puppies.
Everyone needs a dog.
A brace.
Are you trying to drive me crazy?
Let's do a data check. We do this in honor of Steve. Futures up 18. Futures advance. Stay with us this Friday. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
what investors need to differentiate between is, first, where are we in the cycle? Second, what's the direction of the economy?
People are vaccinated and they're still not ready to get up and go and do things the way they did them before.
Quite frankly, no one really seems to believe that inflation's going to be anything but transitory.
What the Fed's objective right now is managing expectations, and they're doing a great job with that.
For as long as you keep interest rates at close to zero, you're distorting everything in capital markets.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance on radio, on TV, on a Friday to begin the summer, to do a mid-year switch. No, that's not John Farrow. On radio, you can tell it's handsome Romaine Bostick in for Mr. Farrow. How does a British guy get a 4-day Memorial Day weekend?
He's
What is that
European.
about?
They get all the breaks, Tom.
They get all the breaks. Mr. Farrow on a well-deserved day off today, and we're thrilled Romaine could come in and do yeoman's duty across all of Bloomberg television and radio today. Futures up 17, Dow futures up 177. Lisa, all of this on the backdrop of a budget proposal. It did move yields.
Do you remember, though, when we used to be worried about uncertainty in Washington, D.C.? There still is a lot of uncertainty, especially as Biden presents this expected to be $6 trillion spending plan. Yeah. It's expected to come down to $3 trillion. We don't know if it's going to get passed. We don't even know if infrastructure spending is going to get passed. We got the counter proposal from Republicans. We don't know how high taxes are going to get increased, too. And the question that I have is, what is being priced in, and does it even matter at this point, Tom?
You know what's so important, Romaine? I got to rip up the script here, Romaine, and get right to the heart of the matter.
I like when you rip up the script,
We're fortunate here, Romaine, to have you with us here, because John, Lisa, and we really don't care, but we know you do on the close, and that is we now have another short squeeze in GameStop and AMC. Yeah. Romaine, money question. Is it different than what we saw early in the year?
It's pretty much the same playbook that we saw earlier this year. I mean, the pain from it is probably not going to be as widespread as what we saw last time, just because I think a lot of folks are a little bit more hedged, and we're getting a lot of data out of S3 partners that seem to suggest that. But when you look at the run, not only in AMC, which has already doubled this week alone, is up about, I think, 20% pre-market last time I checked. You got your Beyond Meats and your Roblox and your GameStops and everything in between also rallying. And once again here on Friday morning, Tom, read into it what you will, but the retail traders have shown time and time again this year that they are certainly a force to be reckoned with.
Who's on the other side of the trade, or more importantly,
the people betting against us?
When does it frame up over a long weekend and such, where somebody goes, no, enough, 28 to 32 on AMC? How do you arrange the other side of the trade to bring it down at some point?
Well, it's basically what happened last time, which is the folks that were short the other side of the trade eventually covered. They pulled back, and that's why you saw the stages. Are we blaming hedge funds?
I mean, honestly, isn't that what you're trying to go for, Tom? Is that what you're saying? Are hedge funds going to have a bad weekend?
I'm trying to be diplomatic, unlike you. Okay,
correct.
Lisa, well, who's going to be, and what's Gensler going to do, Lisa? I mean, okay, it happened once. Again?
Well, look, this has been expected, right? I mean, you have this this Reddit crowd, and frankly, you've got both the people who are saying individuals should be able to trade, and then you've got others saying that you should have some more precautions. If they're winning, it's hard to make the case that the SEC, that the government should protect them.
Unfortunately,
let them make their money. My barber told me last time I saw him on Wednesday, he was all over AMC, and I was like, are you sure? And then, of course, the stock continues to rally. Let them be, Tom. They're the people.
We'll continue this discussion through the morning. John from Coventry just emailed in and said, do a data check. Okay, we'll do it. I'll do equities. Futures up 18, Dow futures up 185, the VIX 16.73. Romaine, pick it up from there.
All right, well, you're looking at euro dollar there. I know, John, that's a favorite of John there, 121.81 right now. Your 10-year yield, Lisa, you talk about all the uncertainty in Washington. Well, all that uncertainty basically leaves us unched. 160.62 right now on your 10-year yield.
Lisa,
if you go back,
I
stole that from Taylor Riggs. You go back 30 days from where we are today, that's pretty much where the 10-year yield was. Then you go back 45 days, that's where it was there. So there's your stasis right now because of everything going on out of Washington and out of the Eccles building. And crude oil, WTI crude, making a bid here, 67.20. Remember, we saw it sort of make a break above 68 a couple of weeks ago, now trying to push back towards that.
Lisa, save us.
Well, we're going to also be speaking to Ed Morris later about commodities. I will just say I will never use unched because, honestly, it's not that hard to say unchanged. changed. It's stasis, and we have seen stasis.
Our show is pacier in the afternoon.
That was hard. Let's move on and take a look at what we're looking at in the day ahead. A slew of data coming out in 90 minutes time. We've got personal income, personal spending, and arguably most importantly, the core PCE deflator. This is the key metric of inflation that the Federal Reserve looks at. The expectation here is for it to increase the most year over year going back to the 1990s. The question is, are we going to be talking, and Tom, this is just for you, transitory? At what point can we say we're seeing something more than that? 10 a.m. we get University of Michigan May consumer sentiment data. This is where I'm looking at in terms of consumer expectations for inflation. How much could you see those expectations rise and affect consumer behavior in the near term? That might have even more legs, frankly, than some of the data that at this point is already backward looking by nature. And today, President Biden is planning to unveil his $6 trillion spending plan. Also, he's going to be talking about the tax hikes that we could potentially be getting. The Green Book going to be released by the U.S. Treasury Department. I'm interested in how much pushback he gets even from his own Democrats. Tom, what would you like to say?
With the importance of our guest, we have to get right to it. Edward Morse will be with us later on commodities and on the prices out there in this moment for the equity markets. Dean Kernit joins from Macro Risk Advisors. Dean, the VIX 19, 18, 17 is 16.72. You are so good at this with the Chicago finance you've got. What is 16.72 describing to market participants?
It's telling us that the people who own options are finding them very difficult to own. Volatility is an asset class. The VIX represents the cost of something. It represents the cost of insuring a portfolio of S&P 500 stocks. And right now, Tom, the calculus that the trader on Wall Street is doing as he or she heads into a long weekend and is seeing a market that's kind of stuck at 4,200, that trader is very simply saying, by holding these options for 3 or more days, am I going to more likely than not make or lose money? And the answer that people are winding up with right now is, I'm going to lose money. That the time decay from this sideways market is enough to force people to jettison the options that they buy. And then secondly, the options that they're forced to buy, let's say from a hedge fund or an investor that wants to sell options, they're not apt to do that because the feedback mechanism of P&L has been negative for folks that have owned options recently.
So there's a question, Dean. Is the calm that we're seeing in markets dangerous? This idea that anyone who does try to bet against this market, this melt up, is getting slammed again and again?
I think that option trading and hedging is really about process and discipline. And an old adage I keep coming back to is hedge when you can, not when you have to. And right now, people don't have to hedge, and that's sort of the reluctance to spend premium. However, what's happening as well is the prices, as Tom mentioned, the VIX is coming down. All of the corollaries to the VIX that represent premiums for insurance, whether it's in FX or interest rates, commodities, they're all coming down as well. So it's a good opportunity to ensure the portfolio, even as things feel like they're stabilizing right now. And that's really our recommendation to clients is let's spend some time really looking at the set of risks that are out there and then make a judgment as to where you're supposed to spend some insurance premium to protect the portfolio, which for me, Lisa, it's inevitable that we'll see at least several more bouts of disruption as we try to get the Fed to land the plane safely. It's an incredibly difficult task ahead of them.
All right, well, as we sort of look, Dean, here for the Fed to land that plane or at least prepare to do it, you have to sort of understand where inflation is and more importantly, where the market is actually pricing those inflation expectations. It doesn't really seem in sync right now, despite the communication that we've gotten from the various Fed members and despite what we're seeing right now with regards to how risk assets are priced as well as how options are priced right now. Dean, square that circle for us. How do you protect yourself?
Well, I think, Romain, you make a great point that inflation expectations are prices that are discovered in the market. And as I think, we step back and we look at the Fed's goal of reacting, so they kind of want to wait it out. But market prices don't wait things out. And one of the chief concerns I have is that as you start to see people doubt the Fed's credibility with respect to its supposed mission on inflation, some of those inflation expectations are rising in a way that's not good. Now, the basic way, Romaine, to protect your portfolio is to do some version of a put option on interest rates, if that's what your concern is going to destabilize the risk outlook. The good news is that rates are incredibly low, so betting on them going up is pretty favorable in terms of the starting price. And I would also argue that the volatility, while very influenced by the Fed, is also very low as well. So the price of that insurance is quite interesting from a cost perspective.
Dean Kernan, Lisa Abramowitz this weekend diving into Sheldon Natenberg's option pricing classic textbook. She's trying to get through half of it this weekend. Let's go all Sheldon Natenberg, folks. This is the one-volume Bible of the Kernan world. Dean Kernan, where are we on Gamma? Have we forgotten what Gamma is?
What's so fascinating right now in the equity derivatives market is there's a real dichotomy. As we've been talking about, the VIX is falling very quickly. I do think, at least potentially, it threatens a new low unless the market starts to move more on an index basis. There's this other side, which I think is really important to watch, and you guys were referring to. It's the explosion again of the meme stocks. It's the right tail of up shocks in these stocks, and wherever there's big movements in stocks, there's going to be big movements in option prices, and there's going to be a lot of volume. And so what we've done is we've designed an index that just looks at the volume of options trading in the meme stocks. And it turns out this index peaked at the exact same time the VIX did in late January of this year. And as that volume came out of the market, the VIX collapsed as well. What we're seeing now over the last, let's say, 5 to 10 days is that volume index is starting to come back up. And we just wonder if you can have this one corner of the market that's just extremely explosive from a volatility standpoint, and this other that's real sleepy. So we think this is an indicator to watch.
We can go on and on, and this is absolutely fascinating and great to have Romaine Bostick with us here to give us some wisdom. Dean Kernan, thank you so much with MacuRisk Advisors. You know, Lisa, a lot of people talk to me about how do you get better at some of this stuff fast. In an options pricing, the Sheldon Natenberg Classic is still the one book.
So that's the reason why when my kids ask me for a dog this weekend, I'm going to refer them to Natenberg's book on options and volatility, and that's what we'll be doing. Happy Memorial Day.
Right through the Greek letters, Alpha,
Mother of the Year,
Theta, Gamma.
They'll thank you like 20 years from now.
Chevy Vega.
You think so? I don't even
it's
think
all there.
So. They'll just cry.
Futures of 17. Stay with us. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Senate Republicans are poised to block the creation of a special commission to study the deadly January 6th attack on the Capitol, whilst initially saying he was open to the idea of the commission, which would be modeled after an investigation of the 9/11 terrorist attacks. Senate Republican leader Mitch McConnell turned firmly against it in recent days. The bill passed the House earlier this month. U.S. climate envoy John Kerry will join climate talks in South Korea next week. He's one of the nearly 50 world leaders and envoys who will take part in the Partnering for Green Growth and the Global Goals Summit, known as P4G. They're hoping to lay the groundwork for new agreements at the COP26 talks in Glasgow in November, when signatory countries are expected to boost pledges to help achieve the Paris Agreement goals. And Singapore is pledging $605 million in additional support for businesses and individuals affected by new virus restrictions. The nation is seeing an uptick in COVID-19 cases. That's prompted officials to reimpose some lockdown measures. Singapore's economy, which depends heavily on travel and services, has been hit hard by the pandemic. And Bank of Japan Governor Haruhiko Kuroda is joining the chorus of central bankers chiming in on Bitcoin following its latest surge and slide. In an interview, Kuroda said most of the trading in Bitcoin is speculative and that it's, quote, barely used as a means of settlement. Federal Reserve Chair Jerome Powell said in April that cryptocurrencies are simply vehicles for speculation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record.
And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shakeup, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered. Expect clear, concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works for inverters.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
In the coming weeks, my administration will take steps to combat these supply pressures, starting with the construction materials and transportation bottlenecks and building off the work we're doing on computer chips. We're also announcing new initiatives to combat anti-competitive practices that hurt small businesses and families.
The president in Ohio yesterday, Cuyahoga Community College on the shores of Lake Erie. Lisa Bramowitz, Romaine Bostikin for John Farrell. I'm Tom Keene. And it was torture yesterday for Josh Wingrove out with the president at Cuyahoga Community College, blocks from the Rock and Roll Hall of Fame. Josh, did you stop by the Rock and Roll Hall of Fame as you exited?
No, we got to save that for next time. We did stop for ice cream. Joe Biden picking up his habit of making impromptu ice cream stuff. Tom, I feel like you have hot takes on ice cream.
Yeah,
Maybe we save them for another time.
Well, we'll save the pistachio discussion for another time. You know, Josh, I look at this and I really want to talk about the Reagan-esque moment of this, and a generational moment of a president saying rising wages are a feature of, to use a phrase from Obama, a better America. How critical is rising wages to Washington?
Yeah, I mean, this was him pushing back in the strongest way to complaints from Republicans that policy, namely those unemployment benefits, those juiced up unemployment benefits, are hurting labor supply, making it impossible to find workers. He's sort of been dancing around that, even focusing on saying, well, hey, look, you know, if they get a job offer, they have to take it. But yesterday he went much farther and said, but not only are we, you know, fine with this, we like this. This is a feature, not a bug. We want companies like McDonald's and Home Depot, which are ones that he signaled out, to be fighting for it.
Right.
And he wants those wages to go up. I mean, he stacked his economic team with people that sort of come from that sort of labor wage school. And so I think they really are leaning into this one. And that other clip that you played, I think, really popped. That was news and hints at news to come, that they're going to do something on construction materials and transportation in terms of bottlenecks. What can the government do on that? The executive branch in particular? We don't really know, but they're teasing it at least.
The other side of the debate, as Greg Valliere features in his AGF note this morning, is the criticism this is modern monetary theory. It is a theory run amok. Is this a theory proposed by the White House, or is there an actual structure, a doability of this to get to the actual budget?
You know, we're going to hear, obviously, about their budget today, and they would say there's a theory. I don't think they would just say they're winging it. And, you know, a lot of their proposals have very long legs on it. We're going to see, you know, how it stacks up against what Congress is actually going to pass. We'll see. But I think broadly, Biden does see this, he said repeatedly, as a crossroads, almost like an FDR type moment to reset the American economy. They make No bones about that. And you know, they want to reorient in favor of workers. Of course, he takes pot shots pretty regularly against corporations for doing in what he views as unnecessary stock buybacks, excessively high CEO pay, and that sort of thing.
But Josh, what is then the messaging of releasing this $6 trillion budget at 1:30 p.m. ahead of a Memorial Day weekend rather than on a Monday morning when Senate is in session so everybody can discuss it and really hone in on the details?
Yeah, I think people are definitely picking up on that. I have not heard them explain their messaging other than that this seems to be the process that they are on. I don't know that they will focus so much on the 1 year number. All his plans, like the American Rescue Plan, the American Jobs Plan, which is still in flux, as we know, the Families Plan, which is probably even less likely to pass, certainly at least in its form. All of those are over, you know, a decade. So they're gonna not focus on that 1 year number. They're gonna focus, I think, on a broader sort of, you know, averaged out number, and we'll see where it goes. You know, Biden, I think broadly, you know, also today will go to Virginia. He's going to make a stop at a business. I think if you read between the lines, he's probably going to talk about what businesses are doing to get vaccinations done for their workers. That's the backdrop here. He says the only reason that they're taking these steps and the economy is growing like it is because, of course, there's progress on the virus.
The other thing I'm struggling with is how realistic is it that any of these proposals are going to get done? And frankly, markets have even priced in a lot of infrastructure already, even though we're getting some pretty contentious debates. Yesterday's a proposal from Republicans. Yes, the headline number was near $1 trillion. The actual new spending they're proposing is less than $300 billion, about a seventh of what Joe Biden is proposing. How much daylight is there here? What are the chances of some sort of agreement in the near future on even infrastructure?
I think you'd be silly not to be struggling with that. That's the million-dollar question right now, because they remain pretty far apart. There are now almost dueling camps of senators trying to come up with things. Biden has said the clock is ticking. He's going to talk with Shelley Moore Capito, the West Virginia Republican senator who's been taking the lead on a lot of this next week. You know, can they close the gap? There have been signals from Republicans that there's something at like the 1.2 range, but those pay-fors are the real X factor, new money or old money.
Yeah, those two numbers that we have on the screen, the 928 versus the 257, definitely a little bit of washing on both sides there, Josh. I am curious about the Republican side of this equation here, because that 257, I mean, they themselves are almost pitching this as a $1 trillion plan, despite the actual price tag that's attached to this bill. Yesterday, we saw Biden when he was out there at that Cuyahoga College, basically holding up that sheet of paper that he said had the names of Republicans that have basically been out there touting the success of his proposals that have already been out there, despite the fact that they're publicly basically dissing those proposals.
Yeah, and they have been, I guess, ever more leaning into that fight. I think that they are falling back over and over on this notion that it matters less what Republican lawmakers think than what people think, in particular Republican voters think. That is how Biden wants to, I guess, reframe the idea of bipartisanship. We'll see if that sticks. I mean, look, there's just not a lot of appetite for Republicans to certainly move to the numbers he wants, but broadly to cooperate. They're just the incentive structure just doesn't seem to be there for the bipartisan.
Well, there may not be an appetite to do it politically, but isn't the point that Biden was trying to make here is that these programs are popular with the public, the people who are actually being helped by it, right?
Yeah. He's trying to bonk all the members of Congress on the head who are voting against this stuff and digging in on this stuff in Washington, and they go back to their districts and they act like they've, delivered a windfall.
Yeah. Everyone just needs to get an ice cream cone. How about that?
I mean, I would love that. Maybe a little early in the morning.
Right. Josh, thanks so much. Greatly appreciate it. Josh Wingrove on the road with the president to Ohio and back in Washington, our White House correspondent as well. Lisa, I look at this fiscal policy and the analysis, and, all the usual players are going to dance their part. But you really wonder where we are at the end of July when we're discussing this out. To me, it's a total mystery with the scale of the numbers.
So Terry Haynes of Pangea put out a report late yesterday after looking at the counterproposal from Republicans. And he said that he actually gives it a 60% chance of some sort of infrastructure deal getting done at about $1.25 to $1.5 trillion. He basically said nobody in Washington cuts a deal just before Congress leaves town unless they want the deal to fail. So it's actually a good sign, according to him, that there isn't some sort of deal that is signed and delivered ahead of the weekend.
It'll be there, and it'll be the stimulus that we see in the equity markets with futures up 16. It's day after day we see the lift in the futures markets. So much of a wrapped around something we haven't talked about this morning, which is the continuing ascent of the Asian currencies. It's very subtle, very nuanced, but renminbi 3 days in a row pops out on yuan 6.3676. That is a very strong Chinese Japanese currency. You see it again with DXY stability. Other currencies struggling, but Asia and the ADXY complex clearly ascended. That'll be one of our themes through the morning. Ed Morse scheduled to be with Citigroup. That is a good thing. Less so now on oil and more Ed Morse on copper. This is Bloomberg. Stay with us.
Okay, traders, it's time to place stop on profit for Japanese yen even further. So follow my trade and place stop on profit at 109.936. It will give us 500 pounds in profit. In your case, it will give us 50 pips. With Japanese yen, with all other pairs, it will give us 5 pips. Okay? Stay safe, guys. If you want to get the strategy, you have to go to company.co.uk and get the strategy from there. The web address you can find on the red line of our streamer. Okay, let's move on. Let's see what other pairs will be available to trade. At this moment, I cannot see much, but we're still in profit. We're already in profit for Japanese yen. And I'll speak to you later when some changes happen. Okay? Speak to you later, guys.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Bloomberg Surveillance. Good morning, everyone. Jonathan Farrow, Lisa Bramwitz, Tom Keene. Mr. Farrow off today. And with us, Romaine Bostic. We'll get to Romaine in a moment. Edward Morse will join us from Citigroup on commodities in a moment as well. And speaking of that, looking at the complex, some stability in oil through the week. It's just under $70 a barrel on Brent crude. I'd note, I believe I heard Matt Miller talk about gasoline on this Memorial Day weekend up near a 10-year high. We'll have to discuss that as well. I'd also note the dollar churning here, having a churning week, but within that is strong renminbi. We'll get to that in a moment with Dr. Morris. And the equity markets, futures up 16. Futures will never go down And now, to explain all that matters, which is GameStop, AMC, and the rest of it, Mr. Boston.
All right,
Did you start there?
No, I'll throw you for a loop here. I'm going to actually start with Ford because this is the other meme stock that's rallying. The old
Ford
school
is a meme stock?
Well, it is now here. This stock having a while. Look, it's up for a fourth straight week here. Right now, up 2%. I'm calling it a meme stock. Jim Farley just doing yeoman's work over there to try to pivot this company towards EV. Remember, they had that investor day earlier this week, and investors seem to like what they hear. This is a company now that is firmly in the conversation about not only making EVs, but really leading in the EV space. Of course, those vehicles still haven't come to market, but this is a company a lot of people think can actually go punch for punch with Tesla with regards to what it offers and how it offers it. Those shares up 2.3% right now in the pre-market, above $15. This is the highest level we've seen on Ford now in several years. Keep in mind, this has been one of the biggest laggards out there. And let's get to your meme stock here, Tom. If you missed it yesterday, AMC was up 36%. It's already doubled this week. It's up 16% here in the pre-market, above that $30 level. I don't know if that's an entry point or an exit point, but it'll be interesting to see whether the short squeeze that has taken us to this 30.73 level, whether that actually holds into today and maybe over the weekend into Tuesday when we come back, of course, with Monday being a holiday here in the U.S. And Virgin Galactic, one of the other meme stocks, having a phenomenal week after that successful test flight, up of whopping 0.5%.
Romain,
yes.
Is there any stock that's not a meme stock right now?
Absolutely. Flip up the board. I'll show you some non-meme stocks here.
Please.
This is old economy, Tom. Look at that. Boeing, right there.
Better.
Down 1%. See how the meme stocks go up, but everything else seems to go down.
Anything can be a meme stock.
Boeing shares down 1% here in the pre-market. Unfortunately, apparently they're pausing deliveries of their Dreamliner 787. Yeah. There was a report out by Dow Jones earlier. Bloomberg has now confirmed this. That's weighing on the shares. HP Inc., Tom. You remember this? This is the company that makes PCs, printers. Yeah, you know, that's not really hot anymore. Those shares down 6% after earnings. And Salesforce, I don't know, I guess that straddles the world of the old economy, new economy, still doing well here, trying to integrate that Slack acquisition. Shares up 5% here after earnings.
Yeah, you know, I could tell you with the brilliance of Bloomberg surveillance is we're on this show, Romain, Anaconda Copper is a meme stock. The only one in the room that remembers Anaconda Copper besides me would be Edward Morris, of course, iconic at Citigroup. Dr. Morris on oil, on the macroeconomics, the geopolitics of oil. But this morning, we focus on commodities. Ed Morris, it's not in the headlines. It's not above the fold in the New York Times or the Washington Post, but it is China ascendant. We see a yuan making a jump condition to yuan strength. Does it signal finally a commodity boom?
Well, there is a commodity boom. I don't know whether that's signaling it. I think what's really signaling it is getting out of a recession. We're having the most remarkable recovery following the most remarkable recession given the pandemic. And all recoveries are commodity intensive in the demand side. And this one is especially so given the depths to which demand had fallen last year.
Tell me the inventory rebuild that's out there right now. It's always a mystery in China, but they load it up. What's the dynamic of inventory of copper, iron, and the rest of it in China right now?
Inventories are really low, whether you look at iron ore or steel or copper or aluminum. Inventories are really, really low. And the question is, how low can they stay in for how long? And it looks like they will stay low for a long time. We look at the scrap market for steel, the scrap market for copper, and they're at record levels. So that's an indication that the inventory of things that go into those products are just not available.
Taking a step back, Ed, just to sort of dovetail both of Tom's questions together, there is a question of how much pricing power China still has over the commodities complex. Goldman Sachs coming out and saying that they've lost that power, especially as developed markets, the U.S., Europe, engage in infrastructure spending. Do you agree?
Yes, I do agree. And we've seen it in the Chinese effort to damp down on speculation. They announced they're going to damp down on speculation. They announced that they're going to damp down on volatility. Prices go down. But then the real inventory situation, the real supply-demand balance picks up. So China's looking for lower priced commodities, and they don't have the power to do that.
There's also a question of whether you can have a commodity super cycle, as many people have been calling this, without the participation of oil. And could you have the participation of oil if you have such pushback by investors on the likes of Exxon and Shell on becoming a greener operation, on adapting to a world trying to fight climate change? What's your view on the outlook for oil given that backdrop?
Well, first of all, I agree with the view that you can't have a super cycle without oil being part of it. And all the super cycles we have seen have had massive disruptions in oil supply is a real kicker. And the reason that is important is that all commodities are energy intensive to a dramatic degree, whether you look at ags or metals, you pick a commodity and it's going to be energy intensive. Aluminum is particularly energy intensive. But then we look at the horizon. There are two things that are fighting each other. One is demand is not growing the way it used to grow. Yes, we're in a recovery, and that's a very robust short-term phenomenon. But we look out to 2030, and the big debate is how far away from the historical growth level in demand, how far down is it going to be? And then we look at the supply side, both medium and longer term. We have OPEC countries, Saudi Arabia and the UAE in particular, that are doing what? They're increasing their production capacity. We have Iran off the market, teetering maybe at the cusp of an agreement with the United States. They have 1.8 million barrels a day of oil offline that's coming back at some point between now and a year and a half from now. And then we have oil everywhere, and the price is lower because of the technological revolution that took place with the last super cycle. So I wouldn't say that this is going to be a write-off of oil. It depends on who has it, where it is, and no matter where you find it, it's going to be fairly easy to produce.
So it may not be a write-off of oil here, Ed, but to Lisa's point that she was making in her question as well, with regards to the pressure that is now on a lot of these fossil fuel companies, the idea that they should be pivoting more to renewable energy in some way, or at least kind of hedging their bets with regards to the outlook for oil demand. Is it a little premature now for these companies, for those companies that have traditionally sort of relied on fossil fuels and made their profits off of fossil fuels, to make that pivot?
Well, it's not premature to make the pivot to decarbonize. How that decarbonization works is another matter, but we have a massive amount of capital going into carbon capture and sequestration. Decarbonizing what's needed, and fossil fuels are needed. It's wishful thinking to think that the world is going to grow power generation that's non-interruptible based on renewables. That's not going to happen in the next 10 or 15 years. So we're in a world where we have to live with fossil fuels whether we like it or not. Mm-hmm. And at the moment, the unfortunate part of the way things are pricing is that oil is pricing below its social contribution.
Yeah, definitely. With regards to, though, the push into more renewable forms of energy, and particularly all of the talk we have here about EVs, part of the commodity boom that we've seen as of late has been, if I'm not mistaken, directly tied to that, particularly with some of the industrial metals and minerals.
Oh, undoubtedly. The demand for power generation is ubiquitous. You take the three largest economies in the world, the European Union economy, the U.S. and China. They're all moving toward that EV world in an accelerating way, and that requires more power generation. And what do you need to do that? You need batteries. And what do you need to make batteries? You need an array of metals. You need nickel, you need lithium, you need copper, you need aluminum, you need cobalt and manganese. So it's a commodity-intensive environment, particularly metal-intensive.
Right. Yeah, Edward Morse, I got one question, and this comes off our important interview with Andrew Forrest, the giant of Perth in West Australia, on green hydrogen. He's got more money than God, and he's putting it into green hydrogen. We're going to crack ammonia and come up with a free lunch here. Do you buy, as a carbon guy, the future of green hydrogen, or is it a myth?
Oh, no, it's by no means a myth. The question is, how quickly will we see the cost structure coming down? There are two major cost structures there. One is the cost of renewables. They are going down.
Yes.
We're seeing
what about the electrolyte?
But the electrolyzer is the other one. And the big thing that we're waiting for is economies of scale. We're seeing electrolyzers really made by, they're not quite ma and pa companies, but we haven't seen the build out of the economies of scale that are required. And that's going to be there. And then the question is going to be location, location, location. Where is there going to be the combination of electrolyzer availability and non-interruptible wind, non-interruptible solar? And Australia is very well positioned on the renewable side.
Edward Morse, thank you so much. With Citigroup, we look forward to speaking to you as we launch through the summer a commodity boom. You know, I look, Romaine, I look, Lisa, at where we are on Bloomberg Green and the idea of looking at theory, but also folding it into price theory and price economics and bringing green hydrogen down to where it's even remotely feasible. We're distant from that.
Well, we are, but Romaine, this has actually been one big conundrum for this year, is that some of the input metals for some of the renewable energies have surged, which actually puts a dent in some of the quest to get greener. And I just wonder how we're going to resolve that.
Well, back to my point about the meme stock Ford, we should point out the CEO there, he was talking about this on Wednesday at that investor day. And a part of what they're trying to sort of sell is this idea of better efficiency with use of those materials here. So the idea you go from 100 kilowatt per hour with regards to the batteries that go into those EV vehicles, and you get that down to something like $80 per kilowatt. So you increase the efficiency here, and maybe that blunts the impact of what you're just doing to the earth.
I mean, I don't have time for it here, Romaine, but we'll bring it up again. What a shock at ExxonMobil to see climate change come in and readjust the board.
Well,
absolutely.
I mean, it's not that shocking when you take a look at the ESG of some of these big firms. What are they going to do about it, though?
It's, well, you know, we make jokes about it, but the pendulum of ESG, it's been an ESG week. Romaine, John Farrell's going, what are they talking about? Do a data check. Futures up 15, Dow futures up 169. Stay with us on a Friday to begin your summer. This is Bloomberg.
With the First Word News, I'm Rich Gupta. The Russian hackers behind the SolarWinds campaign have escalated their attacks on U.S. federal agencies, think tanks, and non-governmental organizations. That's according to a blog post from Microsoft's Vice President Tom Burt. In April, President Biden ordered sanctions against 32 Russian individuals and entities, including 6 companies that provide support to the Kremlin's hacking operations. Japanese Prime Minister Yoshihide Suga is extending a state of emergency for Tokyo and other major cities. It's a last-ditch effort to rein in COVID infections ahead of the Summer Olympics in less than 2 months. Many Japanese citizens are worried the global sports spectacle could turn into a super spreader event. Japan has one of the slowest vaccination programs even in the developed world. Boeing has halted deliveries of its 787 Dreamliner again as the plane maker works with regulators to resolve quality issues with the model. The company says it's working with the Federal Aviation Administration and that there's no impact on the fleet of planes already in service. Boeing resumed deliveries of the jetliners in March after a 5-month pause. As we begin Memorial Day weekend, gas prices in the United States are at their highest levels in 7 years, but experts don't expect the steep prices at the pumps to keep eager motorists off the road. After more than a year of caution during the pandemic, there's pent-up demand for travel. AAA estimates 37 million people will be on the move this weekend. That's up 60% from last year. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ricky Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may
be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
The Fed emphasized that it would maintain a accommodative stance of monetary policy so that inflation averages 2%. I think this policy stance is based on the recognition that it will take time to overcome low inflation once it is entrenched. As you know, this is also a lesson learned from Japan's experience.
The stability he has given to a Japan in turmoil has been extraordinary. It is his 8th year as the governor of the Bank of Japan, and Mr. Kuroda is 76 years old, and he has been their rock through all of their domestic politics. Our rock on equities and charts, so it's David Wilson, Lisa Bramowitz, Romaine Bostic, and Tom Keene. As we begin the summer, David Wilson saying, okay, one more boring chart to get us to summer. You got a bull market.
Absolutely. Looking at the second year of bull markets in U.S. stocks and comparing it to the first year. I mean, it's something that the folks at LPL Financial did earlier in the week, so I sort of picked up on it from there. They looked at 10 bull market periods going back to the 1950s.
Oh, a bar chart. It works on radio. Continue.
Well, you know, what can I say? First year, average gain for the S&P 500 of 39%.
Yeah.
Second year, less than 13%. And there was only one case in which the second year was better than the first. That would have been after the 1987 crash in the bull market that started in December of that year. And LPL is also figuring you're going to get more volatility. Look at where we are now. Again, that 13% average for the second year, we're already up more than 7%.
Right.
And bear in mind, we're talking about, you know, from the day of the low in each case. So, you know, you're talking March 2020 to 21, up 75%.
Okay, David, what's important here? I've got time for one more question and a really important chart. Ben Laidler at eToro's talking about a 3-year double-digit return. I'm not going to pin you down on that data right now, but I need you to come back in June and tell us about Laidler's theory of how rare 3 years of double-digit return is.
Well, I'll tell you, second half of the 1990s, 95 through 99, S&P 500 up 20%.
It's just
Plus, each year.
Lisa.
He's crying. He's crying.
It's just incredible.
Yeah.
Bassett can barely speak. David Wilson, thank you so much. Right now, in honor of the summer, we go to Sonali Bassett, who is in Montauk. She is all left-hand coffee, and she's having that Nutella latte out there.
Yeah, she's wondering what's going on.
Coffee to get the summer in the Hamptons going. Baloney, you know, Sonali, you nailed it when we were talking earlier this morning. What an odd summer. Is it from the Hamptons Inn to the work from office 2021?
Yeah, summer is over before it began. And sorry for everybody, it's raining this weekend before they get to enjoy their coming back to the office June 1st. Citadel does expect everyone starting to come back. People have already been coming back, Tom, honestly. Bankers are telling me, and frankly, their clients, that they're turning away work that they're so busy. So we expect starting on Tuesday, a lot of work, a lot of people getting on planes, seeing clients.
Okay, but what's the ramifications? Come on, I talked to an intern at Morgan Stanley. She's going to be in New York, in the office, et cetera, et cetera. All the fancy guys in the fancy suits and ties take the Sikorsky in to go to the office. In the middle, do they really want to come back?
Well, first of all, people are dressing more casually. I'm noticing that right away.
I am too.
So, you know, maybe ditch the tie for the summer.
The bow tie? Wow. You don't even know what you're asking for, Sonali. It's going to get rough in here. I will say that we are hearing both on one side that it's going to get really busy over the summer with people heading back to the office. And on the other hand, you've got the likes of Citigroup having Worker Appreciation Day today, I believe, saying everybody take the day off because we know that you are beat. So which is it? Are people beat or are they ready to go back to the office?
They are beat. Everybody is exhausted. But
are you speaking personally?
That's why you take today off, you leave early, you have a good weekend, and you have a proper Monday, because it will be busy starting next week once again. Again, biggest hedge funds back in the office. We're expecting a huge slate of deals, IPOs, all in full force, all through the summer, right? There are some firms, right? There are hedge funds that are saying come back in September or come back even next year, and you could have some work-life balance working from home. Firms like Two Sigma, D. Shaw. But again, Goldman Sachs, it's June 14th. That's the day that they expect folks, while JP Morgan expects a greater
Lisa,
July.
we had David Costin in celebrating his whole team was in the office.
Yeah, and he said that it was there was a buzz. It did feel good. Sonali, are you surprised by how many banks have brought employees back to the office sooner than you had previously expected?
So I'm not, because I think a lot of people, the executive ranks, have been back for very many months now. I think anybody who's been pushing to stay home has felt a little isolated from their teams. Things get done faster when you're next to somebody, right? And once the CDC dropped their mask rules or the recommendations, we've seen some banks also drop those rules. So people are back to work. The restaurants are open again. I've got to say, people are in different places. So all my sources that were in Miami are still in Miami. So.
Okay. All right. Well, they'll be back in New York. I mean, the real question here that I think we all want to know, Sonali, is what's traffic going to be like come Tuesday?
It's exhausting already.
Am I going to be able to get an Uber? Because it's already getting crazy out there.
No, I've been walking home every day to try to escape that. The trains are full. The traffic is crazy.
Romaine, if you appear on surveillance 3 consecutive days, you get the use of the surveillance Sikorsky.
That'd be nice.
That would help us. Sonali, very quickly, or 20 seconds. Did James Dimon have a good week?
Yeah. You know, he spent 7 hours being grilled in Washington, and he got his say.
Okay, Sonali Bassett, thank you so much. See you at Left Hand Coffee, way out on in the Hamptons, throughout that out to Montauk as well. See how I nailed that, Lisa?
You nailed
I got my, Hamptons.
Yeah.
Coffee chat
When was the
going.
last time you were at the Hamptons?
It was.
He just starts laughing. It was a transitory trip.
They know I'm transitory. I'm not a big fan.
Yeah, you're a Manhattan kind of guy. You're a above 59th Street, below 81st Street kind of guy.
I'm going to be up, rumored in June. I'm supposed to go up where the gentleman from RBC Capital Markets is in Portland and up the coast of Maine, and
I thought he was going to say it was going like up.
They don't have
I know, exactly.
Guys, they don't have
all the way to 97th Street.
No, Romaine, I may go down to Soho this weekend, but seriously, folks,
wow.
they do not have Nutella lattes up in Maine.
All right.
I will say that you are starting to feel a buzz in Midtown. You're starting to feel like people are coming back.
Do you see it, Romaine? Do you see it, Romaine?
Yeah.
Absolutely, yeah. You walk up and down the streets here, right outside Bloomberg World Headquarters, and you can feel it. I walked home the other day out Park Avenue and just
Romain, this is critical, and you do this on the close very quickly here. Do you see a reset in the equity market because people are assuming better growth than the caution of 2 months ago?
Absolutely, and I mean, you're already starting to hear from a lot of strategists saying that now is the time for a little bit of a rethink. But I mean, we'll see. I mean, like I said, we have key economic data.
Well,
don't forget next week, big jobs report.
Well, is it that, or is it just that everybody has been sitting in triple leverage cash and realized that they missed their entry point is now coming in?
Look at the overnight. We're going to show this chart, folks. You got to stay around on radio to see the overnight repo chart. You're out to
we'll let Tom work out his reverse repos and see how that
as well. John Farrell off today. He's going, what has happened? Lisa Bramowitz, Romain Bostic, and Tom King. Chris Casanti on value in the equity market with MAI. He will join us here in a bit. Futures up 15. The dollar churning. Renminbi stronger. Stay with us worldwide. This is Bloomberg on radio and on television.
Traders, let's move on with our stop on profit for Japanese yen, and I'm going to place stop on profit at 109.986. It will give us 1,000 pounds in profit. In your case, you have to check with your broker. Try to find out, call your broker if you don't know how much broker pays you per pip, and you will find out how much you will get profit from this trade. Okay, great. Good day, good trade. I'll speak to you later. Stay safe. For our strategy, please go to company.co.uk and you will get all the information you'll need. Okay, stay safe.
A little more traffic. Okay. During the pandemic, no traffic at all.
Okay, where do you see the oil market in about 20 years or so?
Non-existent.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Everything is in place for inflation to rise, and I think it's going to rise significantly enough to make the Fed uncomfortable.
Quite frankly, no one really seems to believe that inflation is going to be anything but transitory.
What the Fed's objective right now is managing expectations, and they're doing a great job with that.
For as long as you keep interest rates at close to zero, you're distorting everything in capital markets.
We step back and we look at the Fed's goal of reacting, so they kind of want to wait it out. But market prices don't wait things out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Melting up into the long weekend, marking the halfway mark. Jonathan Farrow, Tom Keene, Lisa Abramowitz. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Jonathan Farrow on a day off. Romaine Bostick gracing us. Yo man's work is evidently the word, the phrase of the morning. It is interesting, Tom, here. $1 trillion here, $1 trillion there. We may be talking about real money.
It's a generational reset. It is stunning, and Josh Wingove, I thought, was really great on it. The president's comments out in Cleveland, and there's any number of ways to spin this, Lisa, including the back-and-forth politics. But wow, is it a throwback to Reagan? Is it a throwback to Mr. Roosevelt of another time and place?
But what's going to actually get done, and even perhaps more importantly, Romaine, what's actually getting priced in? There is a question at this point. Is it infrastructure? Is it a spending plan? What actually have markets reflected?
Well, I think when you look at the bid that we saw into materials, a lot of the commodity stocks, and a lot of the industrial stocks, I think a lot of people are pricing in the upside from that investment. What really hasn't been priced in quite yet, though, is, I guess, some of the potential downside from how you pay for that investment. And I think that's going to be the tug of war that we see a little bit deeper into the year.
Which really raises a question, Tom, about inflation in about 90 minutes, or actually about half-hour time, excuse me. It's just things are going so quickly here ahead of the weekend. It's just flying by on this fascinating Friday. I do wonder what we're going to see and whether it will matter. I mean, at what point does inflation data even matter when people say they're waiting for later in the year to even begin to think about transitory?
Year over year, 3.5% is a statistic, and let's be honest here, on the core deflator, we got a 2.9% survey statistic. Mike McKee will come, I can't do anything with my shirt today.
Maybe
it's radio. It looks appalling. The stay got caught there. Oh. Okay, now we're back to normal. You know, I look at the PCE deflator. Yeah, well, you know we're not. I look at the PCE deflator, Lisa, and I think it speaks volumes about the set of inflation series that everybody looks at. Mike McKee looks at one, I look at another, et cetera. What I'm really looking at is what's called Atlanta Sticky from the Federal Reserve Bank of Atlanta, and I want to know what sticky prices are doing as they micro move, and I'm sorry, it paints an inflation scene.
It does paint inflation, and still you've got Janet Yellen yesterday coming out, transitory, going to pass. This is just a comparison year over year. It's a restart. But Romaine, I'm looking at this, and I got to say, you're starting to also see these labor market shortages and the big question mark around that.
Well, I got to push back on what Tom just said, though, because at the end of the day, it's not just about what you see in the aggregate data. It's really about the inflation expectations, and the market's just not buying it, Tom. You look at, you look at five-year five-year swaps. You look five-year break evens here, and right now it's only priced right around, just slightly above that 2% level. So this is a market, at least right now, Tom, that's not all that worried about.
In respect to Gary Schilling and the arch market economic call of 30 years of disinflation and a deflationary tendency. And Lisa, when I look at Steve Major, or I look at some of the David Rosenberg and others saying, wait, don't be an inflationista. The heart of the matter is technology and what it's done to this American economy.
Yeah, and the heart of the matter also is the fact that people, you killed me for this yesterday, Tom, but people are getting older and we're getting more debt. I mean, honestly, if you put that demographic, that backdrop, that leads to slower growth, full stop.
Record number of cardboard boxes out this morning in front of the Keene man. It's unbelievable, the effect of this technology and all that we've seen. And that is a good time to catch up with Christopher Crisanti, moving from growth to value. And at MAI Capital, well, they're considering growth again. Chris Crisanti, in your research note, you say Amazon, buy it.
I do, Tom, and that's weird for a value guy.
But what the listeners have to realize is that Amazon's underperformed the S&P for a year now. So the pendulum has clearly swung to value with energy and financials. I think this is maybe the first time in 3 or 4 years investors really have a time to buy, not just Amazon, but high quality tech and communications at a relative, and I underscore relative, value to where they usually trade. And the reason I really like them, Tom, is the earnings in the first quarter weren't just good. They were absolutely terrific. So these aren't folks that have underperformed because they're, anemic. They're underperforming because they're not the value, the flavor of the month. And I think that provides an opportunity.
Chris, are tech stocks independent of rates? In other words, can you just look at those earnings that absolutely crushed it and bet on them regardless of what benchmark 10-year yields do?
Yeah, Lisa, I think we'll look back in 2 or 3 years, and I do suspect that interest rates will be higher. And I think we'll see the big lie of this period, for investors at least, is that interest rates are bad for technology stocks. The discount rate is lower. If earnings come through, and they keep coming through because the economy is strong, these are going to be terrific long-term investments. And I don't care if 10 years at 1.6 or 3 or 3.5.
And it's not only about the earnings growth as well, Chris, it's also about the revenue growth. And I guess more importantly, some of the pricing power that some of these companies have. So when you look at the Amazons, you look at a lot of these big tech companies here, is part of the appeal or part of the appeal in a rising rate environment, the power that they're going to have over the consumer and over the market to sort of set rates where they want them to be?
You're absolutely right, Romain. And if we are in a little more of an inflationary environment, look, Google and Facebook, for example, they're advertising companies. And they'll push the price of advertising up. And these guys will ride the wave of inflation. I'm more scared of wage inflation. And most of these folks, by the way, with the exception of Amazon, are employee-like. They have amazing productivity per employee. So wage inflation isn't going to kill a Facebook or a Google. So, they're pretty well set up for a world with higher inflation. So I wouldn't believe that higher rates are going to be necessarily bad for these companies long term.
All right, Chris, we're almost coming out of the COVID crisis, knock on wood. Hopefully this sticks here, heading into what is now the unofficial start of summer. A lot of people getting back out. They're starting to spend. A lot of investors looking into that reopening trade, trying to trade, I guess, and invest in the companies that I guess could potentially benefit with all of us getting back to normal here. Has that already been priced in to the values of some of these stocks?
Boy, I sure think so, Romain. I mean, we've been talking about a quote-unquote reopening trade for 9 months now. I walked into a Walgreens a few days ago, and there were row after row of hand sanitizer on sale. So the world is dynamic, and people discount stuff, and I think the market has discounted the value reopening trade. These energy stocks had their day in the sun like they haven't for 10 years. And I just think it's just too late in the game to go there right now.
Chris, what's your study of pricing power right now? We're on the edge of the late Jack Welch, where we're really talking not day after day, but twice, 3 times a week. Somebody emphasizes pricing power as being important. Is it?
I think it is. I think it is right now, Tom, and I think it will get more important. I think we are entering a period that we haven't been in at least 10 years and maybe 25 of, moderate to higher than normal inflation is coming. And I think commodities are the headline, but the sizzle, but the steak is wages. And I think we'll start to see that early next year. So if you can't price to overcome the headwind of inflation, then you have a problem. And I think that will become more obvious in next year and especially in 2023.
Chris, just to wrap this all together, there is this idea that big tech is defensive, that is the defensive play. I want to give you a chance to clarify, is your call to bet on some of the big tech names a defensive characterization, or is it simply that's where the money is and it doesn't necessarily undermine the call to go into cyclicals and other sort of more highly sensitive areas of the equity market?
Yeah, Lisa, I would say at the end of the day, we love talking on the radio and television, but we're green eye shade mathematicians. And the math just looks really compelling for these tech names. And frankly, it doesn't look so compelling now that they've gone up so high in price for the energy and financial names. So, yeah, the PEs are higher in tech, but the earnings growth, and as Romain pointed out, the revenue growth is much higher. So I think the real value right now is in tech. And frankly, I would fade the reopening value trade.
Chris Crisanti, thank you so much. Greatly, greatly appreciated. A different Crisanti this morning. You know, Romaine, I'm going to look 10 years back in this great bull market. Lisa, jump in here as well. Romaine, let me start with you. We have a Standard & Poor's 500. I got to do this again here, folks.
Okay. Break out the
you know, I got that. Well, no, I don't have the 12C out, but I'm using the great TRA function on the Bloomberg, a great secret of Bloomberg surveillance. I was right. I couldn't believe my number. S&P 500, 21.9% per year last 10 years. Remain all those certitudes of single-digit actuarial assumption. The great miscall of this market.
A great miscall here. And then when you break that down, you talk about that 20% growth rate that we've seen here, and we talk about value versus growth. You talk about an underperformance of something like 34% over the last 10 years with regards to those value stocks. And of course, the flip side of that is that momentum, those growth names that it's funny, a lot of those momentum and growth names over the past 10 years, Tom, now people are touting as the new value stocks, whether it's Amazon, Apple, whatever you will.
Well, there's also a question of how long this can continue, how much we're bringing forward some of those returns. And I will say that the one pushback to that, at least in comparison to bonds, is that you're seeing the dividends increase at a lot of companies. And at what point, Tom, are stocks the new bonds?
Well, that's a really important, going back to our interview with William Priest on shareholder yield, this is a huge mystery, Lisa, end of the year, is the share buyback dividend dynamic that we're going to see from companies. Lisa, I'm sorry, I don't think we have a clue what that's going to be.
No, although you are seeing increases in dividends that are pretty steady, Romaine. You probably have been outlining this every day on the close. Well, no, but this whole idea of value and the idea that people are bidding up income at a time where you really can't get it in a lot of these fixed income complex.
Yeah, and I think that's really been what people are keeping an eye on. Like I said, I mean, when you look at what's going on in the fixed income space, the traditional area of income and safety to a certain extent is just not there. And people are finding that income and safety, believe it or not, in equities, some equities.
What's terrible here, Lisa, Shonali handed me a Nutella latte.
Yeah.
It's really, it smells great.
It smells great. So where's the terrible? Should we say it's
Tom's
transitory?
A convert. We'll see him at left hand.
For me, it's transitory. I'm going to go back to the Tang. The Tang will get me through the morning.
Spike Tang.
Yeah, Fritz is up 13. Dow Futures up 146. We welcome you on this Friday of Memorial Day, the sacrifice of our American military. Bharat Ramamurthy of the White House next. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The Russian hackers behind the SolarWinds campaign have escalated their attacks on U.S. federal agencies, think tanks, and non-governmental organizations. That's according to a blog post from Microsoft Vice President Tom Burt. In April, President Biden ordered sanctions against 32 Russian individuals and entities, including 6 companies that provide support to the Kremlin's hacking operations. British Prime Minister Boris Johnson's facing criticism for his meeting today at 10 Downing Street with Hungarian President Viktor Orban. Johnson says he won't hesitate to raise human rights issues with Orban, an anti-immigration nationalist who has clamped down on media and judicial freedom. Johnson has held relatively few face-to-face meetings since the coronavirus pandemic began. And Germany's president said today he will seek a second term. Walter Steinmeier says he wants to help heal divisions widened by the coronavirus pandemic. Steinmeier made his pitch for another 5 years as Germany's head of state, 4 months before the country elects a new parliament. Before becoming president, Steinmeier served 2 stints as Chancellor Angela Merkel's foreign minister. And investors flocked to safety in the past week, putting $68 billion into cash in the biggest addition since April 2020. Bank of America says gold funds, another haven, saw the largest inflows in 16 weeks. It's a sign that whilst equities remain popular investment instrument, market players are looking for alternatives over concerns about inflation and elevated equity valuations. And finally, Morocco's parliament has voted to legalize the local cultivation of cannabis for medical and industrial use. It's a potential victory for marginalized farmers in the world's top exporter of the drug. Global News 24 hours a day, on air and on Bloomberg Quick Take. I'm Rishka Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record.
And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Particularly, sort of the technology landscape have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
My judgment right now is that the recent inflation that we have seen will be temporary. It's not something that's endemic. I expect it to last, however, for several more months and to see high annual rates of inflation through the end of this year.
Secretary Yellen there, she has a huge task ahead of her, and the budget is the proposal is made and the disposal will be done. Right now on the budget, Bharat Ramamurthy joins Lisa Bramwitz, Romaine Bostic, and myself here on Bloomberg Surveillance. He is National Economic Council Deputy Director. He's also a member of one of the most distinguished Indian families in America. I'm not going to go through the details because of time, but Bharat, I've been dying to talk to you, no pun intended, in the tragedy of Tamil Nadu. So close to Ceylon, so close to Sri Lanka. Your parents came from there. What have you heard from southern India in the last number of weeks with their pandemic challenge?
Well, look, it's tragic what's going on in India. A lot of my family is still there, especially a lot of my older relatives. So, we're on pins and needles, hoping that they make it through okay. I know that the United States has taken steps to assist India in dealing with the pandemic, including sending oxygen, which is badly necessary there, and of course taking the steps that it did on the vaccine patents. And so I know the administration is looking at all we can do to help our brothers and sisters abroad, including those in India.
I would be pleased to talk to you about this further, but just because of time in the news flow today, we cannot. Let us go to our economy. Republicans will say this budget will break America, that it's non-doable, the taxes can't be had. Respond.
Well, actually, I think that the budget demonstrates that there's a fiscally responsible way of ensuring long-term sustainable economic growth in the United States. What the budget calls for is a series of investments in our infrastructure, a series of investments in our families and in 4 additional years of school, all of which are about improving and increasing the productive capacity of our economy over the long term. Consider the fact that 30 million Americans don't have access to high-speed internet right now. What do you think it does for the economy to go ahead and connect those folks in rural areas, on tribal lands, and elsewhere? Right now, there are 400,000 schools and child care centers that get access to water through lead pipes. even though we know that that poses a danger to the long-term health and safety of our children. The president's plan would call for ripping out and replacing all of those pipes, which not only creates good jobs in the short term, creates long-term success in the economy. And the budget lays out a fiscally responsible way of paying for all of these investments, such that from year 15 onwards, the deficit and the debt actually starts to reduce over the long term. So look, I'm not going to take a lecture from the same Republicans who voted for a $2 trillion tax cut a few years ago that had no discernible impact on business investment and that exploded the deficit by between $1 and $2 trillion.
Bharat, there is a question, though, especially if you're counting on this plan to start to pay for itself with respect to economic gains, what role the Federal Reserve plays in keeping borrowing costs low. A lot of people talk to the servicing costs of the U.S. government debt, say it's pretty low because of how low interest rates are. How much are you relying on the Fed to be an active player in keeping rates down?
Well, look, the budget assumes a certain level of interest rates over the long term that I think is entirely reasonable. The other part of this is that there are new tax revenue coming from large corporations and from wealthy individuals. You know, in 2018, the effective tax rate paid by U.S. multinational corporations was 8%. And compare that to the tax rate that small businesses pay, compare that to the tax rate that your average middle-class family pays. There's clearly capacity for these companies to pay more in taxes, to help finance the investments that, by the way, are going to be good for those companies in the long run. Better roads and bridges, broadband internet, and so on. This is a win-win scenario.
Bharat, a lot of people say that higher taxes leads to slower growth. What would you, how would you respond?
I just don't think that there is a strong empirical case that the taxes that the president has put on the table, when paired with the investments that he is proposing, are going to have a negative effect on growth. In fact, quite the opposite. The independent analyses have shown that they produce more economic growth in the short term and the medium term. They create more jobs, and that they also create high-quality jobs, which is central to the president's message here. If you listen to his speech yesterday, his main point was that we should start looking at the health of the economy. We should measure the success of our economy based on how working families are doing. Are they getting a wage that allows them to support themselves and their family? Are they able to work at a job with dignity? Do they have choices when they enter the labor market? That's the kind of economy the president wants to build, and that's the kind of economy that we are starting to see emerge coming out of this pandemic thanks to the president's actions.
So then do you dismiss, I guess, some of the more normal metrics that a lot of people would look at with regards to debt to GDP ratios and deficit financing? Is that not part of the calculus inside the White House?
Well, I think it's relevant to look at the interest payments that the United States is going to make as a portion of GDP. If you look at that metric, it's clear that by historical standards, we're actually very well positioned, in part because interest rates are low, as you noted. And so from our perspective, this is the right time to make these investments, not only because of that factor, but because we have a unique opportunity as we are emerging from the pandemic to rebuild certain parts of our economy that are going to need rebuilding anyway. And I would just make one final point here. Our international competitors aren't holding back. China is making enormous investments in its infrastructure. The EU announced significant investments in its infrastructure. Japan, there is a race to win the 21st century. The other countries are starting to run. We can't just be sitting on our hands.
Bharat, the messaging that we've gotten from you and other folks at the White House has certainly been compelling. I'm curious, do you guys have a clear ally on Capitol Hill to actually shepherd this through, a powerful ally?
Look, I think that there is broad bipartisan support for many of the elements of the plan that we are talking about. First and most importantly, among the public, where the president's plans are polling consistently at 60 or 70%. And I think that many of the elements that the president has put into his plan emerge from existing bipartisan legislation. So, for example, the president has proposed investments in affordable housing. There's broad bipartisan support for expanding tax credits that promote affordable housing. So if folks are going to be consistent with their previous positions, I think that there should be a lot of bipartisan support for these provisions.
Bharat, thank you so much. Bharat Ramamurthy, the National Economic Council Deputy Director this morning from the White House, as the spin begins on proposing. It has been a sobering week. Joe Weisenthal had out a great chart on the global COVID cases and deaths. It is not America. We saw that with the lockdown of Melbourne in Australia, and now Malaysia announces a full nationwide lockdown. And what stuns me here, Lisa, is for 14 days. I didn't expect that.
Yeah, it really shows also the lower tolerance for COVID cases in a lot of places. We saw that in Japan. We saw that in Singapore. And the question is, how do you get vaccines to some of these other parts in the world in order to end the pandemic globally? It is not America, as you said, and the United States. How much are they going to start shipping some of their supplies out to others?
It will be remain to be seen. We're going to see, I think, a lot more on this through the weekend as well. We're going to come back. We've got a lot of economic data. Michael McKee will join us. Stephen Stanley will join us. And I really want to dive back in with Romaine Bostic on what we're seeing, something we don't talk about all that much, which is this massive short squeeze out there, the ramifications for all of us in the market. Futures up 11, Dow futures up 131, the VIX 16.80. Michael McKee on disinflation or inflation next.
closures and the complexities of COVID, it became apparent that if we could provide this course in South Australia, it would benefit trainees of anaesthesia in the state.
I feel like I've got some excellent skills to take away from the course, and I'm very grateful that it could be run in Adelaide.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shake-up, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
A capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
plethora of economic data, and even more important economic data. There's very few empire data statistics of Buffalo, New York here. Michael McKee begins the data swamp that attends us this Friday before Memorial Day. It comes out slowly. I guess we begin with what we've got. There we go. Which one matters?
Well, a lot of it matters, Tom. The interesting news here off the top, the advanced goods trade balance was expected to set a record. It does not. Last month, 90.6 billion. This month, 85.2 billion. That will add a little bit to growth this quarter, and it is something of a surprise. So we start off with a little bit of good news there at the margin. Now let's look at the numbers that matter today. The income and spending numbers. Income drops by 13.1% on the month of April, but it was up 21.1% the month before. Basically, what's happened here is the stimulus checks went out in March, and everybody cashed them, and they're not getting it now. Personal spending is up 0.5%. That's what was forecast, so we're on line there. That comes down from 4.2%, but again, the stimulus checks faded. And then the PCE inflation numbers, this is the one everybody wanted to see. The month-over-month PCE comes in at 0.6%. That matches estimates. It is up a tick from, well, actually not. The revision, I'm sorry, the revision shows that a month before it was at 0.6%. So the PCE deflator, this is the headline number, is up 3.6% on the year. That's a tick more than the Fed, than the consensus 3.5%. This is the number that figures into the Fed's mandate. They look at core because it tells them more, but the number they're working towards is that 2% figure.
Mike, I'm looking at a wall of data like you are. You're doing this in real time. You've got the toughest job at Bloomberg, but I'm seeing one statistic that sticks out like a sore thumb, and that's on PCE. We go out with a revision out to 2.4%. We're looking back 60 days of greater inflation, right?
Yeah, we've had a little bit more inflation over that time period. Look at the core. The core comes in hotter than expected, and that's going to bother a lot of people. Right. 0.7% for the month of April, and the year-over-year number hits 3.1%. Let's do a quick calculation here.
Okay, you do the calculation, Romaine. Tell us about the data right now.
Well, the data is basically stasis here, at least in the equity markets, 42.12 roughly and change here on S&P futures. That's pretty much where we were just a couple of minutes ago. Are seeing a little bit of a a little bit of selling pressure here in the Treasury markets. 10-year yield right now ticking up slightly to around that 161 level. A little bit of activity also in the 30-year as well as in the 2-year dollar, Bloomberg Dollar Spot Index right now up about 0.3%. Again, that's pretty much where it was slightly before that. So again, you have a market here, guys, that really is, I think, has their eye heavily on that PCE number and really trying to sort of parse what does sort of a 1/10 of a percentage point tick up or a 0.6 tick up or a revision of a fraction of a percent tick up. What does that mean here for prices going forward?
Futures up 14. Lisa, gets us out to later this morning, the expectations of inflation from Ann Arbor.
Well, the idea here is how much are consumers looking at this. You've got that University of Michigan consumer survey coming out at 10 a.m. How much are they looking at this, expecting higher inflation and adjusting their expectations for wages, as well as for how much they spend on different base items in their day-to-day lives? Thank you so much, Michael McKee, as always, for parsing through the data. There is a question of, does this data matter, or do we just really have to wait until September, October, November to determine whether this is transitory or not? Stephen Stanley has been parsing through all of this. Amherst Pierpont, chief economist. Does it matter that the PCE deflator, the key indication of inflation that the Federal Reserve looks at, came in higher than expectation at the highest levels on a year-over-year basis since the 1990s?
Good morning, Lisa. Yeah, I think it does matter. I mean, I think you're right. The Fed is going to try to wait it out. And there's no question, if you look at the detail of the April data, that most of the uptick in inflation is what the Fed would call temporary factors. But that can get embedded in the fabric. And I think you rightly highlighted those University of Michigan inflation expectations numbers, because it was pretty shocking a couple of weeks ago when the long-term inflation expectation number ratcheted up quite a bit. I think the Fed is confident that inflation expectations aren't going to move, but we haven't seen these sorts of inflation rates in a very long time, and I think it's the reaction of people in the economy could be very unpredictable.
Stephen, could you talk a little bit about why inflation expectations are so important in determining the true path of inflation?
Right. Well, I mean, if people expect inflation, then they're more willing to accept it. And they're also more willing to demand higher wages to make up for it. So, back in the 70s, we had what economists called a wage price spiral, where every time prices went up, workers demanded higher wages, which in turn forced inflation higher, and it just kind of fed on itself. And we haven't really seen anything like that for several decades, and the Fed is confident that we're not going to see it this time. But again, in my mind, we're kind of in virgin territory here. We haven't had an economy like this where supply is being outstripped so severely by demand in a very long time.
We'll talk a little bit more about that, us being in virgin territory, because when you look at sort of the past economic pressures that we've been through here, really hasn't come as much from the supply side as it has this time around. And I'm wondering if at some point that does actually start to rear its head with regards to wages and put that upward pressure that may actually cause some concern for investors.
Right, absolutely. And I think, one thing that's going on right now is for a combination of factors, and certainly the extra unemployment benefits have been cited by a lot of folks, and is probably an important reason. But people at the lower end of the wage scale are very hesitant to go back to work right now, and firms are raising wages pretty significantly for those types of jobs. And it's hard to take that back. And certainly many people would look at that and say, hey, that's a great thing. People are getting paid more, and that's well and good. But then how does that get adopted in terms of how the companies tend to price? So, fast food restaurants have to pay $3 or $4 extra per hour for their workers. Does that mean that your $1 value meal becomes a $2 value meal? That's how inflation gets started. So that's, I think, what the Fed is going to be watching, is how much pricing power do firms have, and does it look like consumers are more willing to accept those price increases versus where we've been over the last, say, 20 years, where consumers have been very resistant to those sorts of price increases.
So I got to say, Tom, when you take a look at what we're seeing, you do have to wonder at what point people look at this and they say, we have to look past the noise, and we are looking to something that is longer in its nature.
And Lisa, what's so important here is Michael McKee points out, and folks, the job Mike has to look at this wall of data that comes out, and he sifts through it, and he really mentions the finally decline in the savings rate. Stephen Stanley, you are acclaimed at nailing the market economy. I assume you've never seen savings rates like this. Explain to our radio and TV audience why guys like you are riveted on a savings rate of 20% down to 14%
Well, it's important to remember that the savings rate is a flow, and the savings rate went up a lot in March because there was, as Mike said, there was this massive influx of rebate checks. So the savings rate goes down in April simply because income is not as high, because you don't have that artificial boost from the stimulus checks, but it's still above 10%. I mean, in normal times, savings rates in the mid single digits. And so what's happening is every month people are putting away more money than they normally would. It made sense for that to happen in the pandemic because people simply couldn't spend on everything they wanted to buy. Now that the economy is reopening, households have a tremendous stockpile of dry powder that they can deploy. And the question is really, does it get spent all at once, or does it get meted out over time? I think it's likely to be the latter, which is why I think the consumer's going to have a lot of staying power for quite some time.
Well, actually, and this is important, and Michael McKee highlighting this, as Tom just said, that we did see that personal savings rate come down to 14.9% from 27%. It seems like people are out there spending in force. At what point, Stephen, do you adjust your expectations for GDP, for inflation, for activity in the economy based on the savings rate coming down so rapidly?
Well, we'll see what it does once the impact of the stimulus checks starts to, once that abates. In May, will be the first clean month that we've had in a while on that front. But look, all through last year, the savings rate was still running much higher than normal. And so at some point, I would expect the savings rate should go down. And if anything, it should go down to a below normal rate, right? Because people are kind of flush right now. They don't need to save. And they're probably going to want to be spending. So we're hearing all this pent up demand for travel and all the fun stuff that we haven't been able to do over the last year. So I would expect that as we get later in the year, the savings rate will actually go down dramatically.
Fascinating. Stephen Stanley, thank you so much. Really interesting economic data and more to come this morning as well. Romaine, when you look at the savings rate, the wall of money that's out there, we've all identified it. I don't buy for a minute there's an assumption it just pours into the market. What do you read?
No, and in fact, a lot of the strategists we've talked to have basically said that that money might not come back, at least not in force, that a lot of people are banking on. And a lot of that has to do with why people save to begin with. Again, a lot of that is about the uncertainty, or at least the perception of uncertainty going forward. I'm not sure there's any more clarity today about the economic trajectory than maybe what people had a year ago. In fact, I'd probably say it's even more muddy now.
Yeah, well, it's going to be interesting to see. Futures pair back a little bit, up 13. Dow futures up 156. And on we go through the morning, and of course through the 9 o'clock hour. Good conversation to get us to those important Michigan numbers. Lisa, what do you have?
I gotta say, I'm wondering why the market is so sanguine about this idea that inflationary data has been coming in stronger than expected time and time again, and people are buying what the Fed is selling, that this is going to be transitory. What are they seeing that gives them that conviction? What are we gonna see that that could potentially upend that? We're gonna be speaking about that coming up in the next hour on The Open with Megan Green, Harvard Kennedy School senior fellow. Romaine, this really is the question. Where does that conviction come from?
I think the conviction comes from the fact that this is a market that's been spoon-fed by the Fed now for the better part of a decade, if not more. And if the Fed tells them it's transitory, a lot of people are willing to buy into it.
Well, but this is actually, this is the issue to me, Tom. People have been conditioned by the fact that we never got the inflation that people said we would get, and yet everyone is saying this time is different, given the fact we've got low rates and the incredible fiscal spending.
I anecdotally would state the inflation is tangible. And you look at the numbers on the screen, you know, we're benumb by it. We're looking at the market and quoting all this data, but you know, Romaine, I go back to PCE deflator. You're looking at 3 handles on some of these statistics.
It's certainly tangible, but there's a question of that. Some of this inflation is sort of in pockets. It's not as broad-based as some people think. And the question is whether it's persistent, Tom.
Pockets of Glossier.
All right, we can fight after the show.
Lots of pockets in the brown boxes that show up at the Keene household.
What is that, Chewy boxes? Amazon?
Everything. Amazon, Chewy, Glossier.
Yeah, there's a Chewy delivery today now that I think about it. Futures up 13. Stay with us. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden will kick off congressional spending negotiations today when he sends lawmakers his fiscal 2022 budget plan. Lawmakers face debates about the size of the deficit, how much funding to provide the military, and whether to end a ban on federal funding for abortions. Budget negotiators may need a stopgap funding measure to avoid a shutdown after the September 30th deadline to fund the government. The UK has cleared a vaccine for use from Johnson & Johnson. It's the first single-dose shot to be authorized in Britain. The move gives Britain a 4th shot in its arsenal, though its use may be initially limited since more than half the population has already received at least 1 vaccine dose. Japanese Prime Minister Yoshihide Suga is extending a state of emergency for Tokyo and other major cities. It's a last-ditch effort to rein in COVID infections ahead of the Summer Olympics in less than 2 months. Many Japanese citizens are worried the global sports spectacle could turn into a super spreader event. Japan has one of the slowest vaccination programs in the developed world. And Apple's getting ready to revamp its line of AirPods. Bloomberg's learned the company plans to unveil a newer version of its entry-level AirPods this year and a second generation of the AirPods Pro in 2022. Apple's wearables, home, and accessories segment has grown rapidly. It now counts for more than $30 billion in annual revenue, exceeding 10% of total sales. And Americans will be paying a bit more for their Memorial Day holiday weekend barbecues this year. An index compiled from the Bureau of Labor Statistics data tracking retail prices for 6 staples, including ground beef, cheese, and potato chips, has been on the rise, and in April reached a 9-month high. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think you want to be sensitive to the idea that inflation could take off. Of people talking about inflation, I don't see too many of them saying, I really am confident I know where inflation's going. There are a lot of opinions floating around, and that's really the point. I mean, it's you can't forecast these things, and even if you could forecast where inflation is, you don't know what the effect's going to be on the stock and bond markets.
Well, David Booth, Dimensional Advisors, talking here about the challenges of investment in a most unusual time. That drives forward the conversation. Wall Street Week tonight, 6 p.m. In New York. Romaine Bostick and Tom Keene. Lisa Bramwell was preparing to drive the Faro show open this morning at the Open as well. And Romaine, if you look at the CFA Institute, it really is equity theory turned on its head with where we are right now.
Yeah, and look, I mean, we talk a lot not only about the rotation that we've seen into, I guess, the so-called value, but you talk about, Tom, here, of course, also about the push now into some of the stocks, I guess, maybe that aren't quite as value.
This is a joy for Romaine Bostick and myself. The dirty little secret, folks, is you read the CFA Financial Analyst Journal and you get some of the math. And what you do is you turn to a Rob Arnott article. He held court for 4 important years with the CFA Institute and has been definitive in driving forward academics in what we do at the CFA Institute and what we do in equity investment. Rob Arnott, of course, from UC Santa Barbara and with research affiliates this morning. Rob, do the theories that I read from you in the CFA Institute ages ago, do those theories still hold, or is a new paradigm where the risk-free rate is?
It is no new paradigm. We have always had bubbles and markets acting in occasionally irrational ways in pockets of the market. The risk-free rate right now is manipulated by central bankers all over the world, is artificially held negative. And if you think of interest rates as a speed bump to discourage reckless investing, we don't have speed bumps. And so we have misallocation of resources. We have zombie companies propped up. It's not pretty, and the risk is that it doesn't end nicely.
The end of the debate here, and this goes to, if you take a balanced approach now with a high R squared to the market, the bottom line is your results have been on the edge of mediocre versus the glory of the FANG stocks over the last 18 months. Rob, you know the story. Is Amazon, and I don't mean Amazon specifically, but is Amazon a value or a growth stock to research affiliates?
Amazon would definitely be a growth stock, and growth stocks are better companies. That's why they command higher multiples. But the quality of the company and the quality of its future growth prospects are not unknown to the market and are fully reflected in share prices. So one of the things that we've worked on, in fact, you mentioned Financial Analyst Journal, in the first quarter edition of the FAJ, we had a paper examining the value effect and found in our research that the value effect is alive and well. Value stocks win relative to growth stocks, but not when they're becoming cheaper in relative valuations, which is what's been happening in the last decade.
And what's great, Rob, is Romaine Bostick read that article, every word of it, every coefficient. It's the only reason we got you on the show, Romaine.
Yeah, we'll see if I can remember half that stuff. We'll find out in 6 to 8 weeks. Rob, I am curious here. We talk about sort of the definition of value these days, and a lot of people have, I guess, taken the market environment and, more importantly, the Fed environment to sort of redefine for themselves what value can be or how they should do it here. If we actually ever do or get some sort of normalization of monetary policy, a normalization at the same time of fiscal policy here, do we revert back, I guess, to what we would normally consider to be value and growth? Does that sort of spread back out, that gap?
There are so many catalysts that can revert things back towards normal. A normalization of fiscal policy, a normalization of monetary policy, could be the catalyst. It could just be, as in the case of the tech bubble in the year 2000, just plain old gravity can bring the high flyers back down to earth. So when we were working last summer on the paper examining the value effect, one of the things that's interesting is over the last dozen years, if you use price to book value, which is the conventional way to measure value, the value stocks underperformed the growth stocks over the course of a dozen years by 58%. That's huge. That's the biggest drawdown ever. But they got cheaper relative to the growth stock by 68%. Now, if you have a stock that's gone down 58% and its PE ratio has gone down 68%, what's that tell you? That tells you the earnings are up.
Right.
That tells you that the stock is healthy and the market's opinion of the stock is the source of the drawdown. So when you look at things from that perspective, do you take a stock like that and say, can't stand the pain, get me out of here? Or do you look at a stock like that and say, I can't believe how cheap this is. If I can possibly have the courage, let me double down.
Well, then on that point, then you go back 20-something years when we sort of had this conversation before about the tech bubble in the late 90s and the early aughts there. And there were a lot of people also trying to make these decisions about what was value, what was growth, and what would actually be around. Now, we know some of those companies, of course, went on to become the Amazons and Microsofts that we now sort of hold dear here. How do you sort of parse that in today's environment where you sort of look at maybe this new breed of tech stocks, these new breed of biotechs and EV companies, and decide which are the ones that actually do have that long-term growth potential, that long-term value?
We wrote a paper just recently entitled Big Market Delusion, in which we pointed out that what happened in the tech bubble in 2000, what happened in the EV market, electric vehicles market last year, was a situation where the pricing of these assets went up and up and up, and they went up in a context of a perception that they were all going to be winners. But they compete with one another. They're market disruptors, and disruptors get disrupted. Of the 10 largest market cap tech stocks in the aftermath of the tech bubble in the year 2000, how many of them beat the S&P 500 over the next 10 years? Zero. One beat it over the next 20 years. That's Microsoft. It underperformed for 10 years, then it outperformed for the next 10 years. Net, on a 20-year basis, it beat the market by a little over 1% a year. The average for tech stocks was 8% a year under.
Rob, we're out of time. All I can tell you is weekend reading for me has got to be Rob Arnott in the great Peter Bernstein 2002. It was a classic paper. For those of you who have nothing, you're done with Queen's Gambit and all the other streaming, just read Arnott Bernstein and you'll be happy. Rob Arnott, thank you so much. Greatly appreciate that as well. Futures up 10, Dow futures up 136. We stagger through the month. Romaine Bostic.
Yeah, I'm sticking around.
Take the surveillance nap.
I will.
Just stay around this morning. Great to have you with us. Stay with us this Friday, Memorial Day. This is Bloomberg.
Okay, guys, as you can see, we closed position on Japanese yen. All of you guys who followed my trade, well done. You made a profit. It took us quite a while. It took from about 9 o'clock. We entered position and we closed just right here. So great trade, well done. And let's move on to, I'll show you where we closed, just right here. A few minutes ago, about 20 minutes ago, we closed position. And let's move on and look for other opportunities and chances to make, place, and trade and get profit from it. If you want to get a strategy, please go to company.co.uk and you will discover all these secrets, you will get the strategy, and you will start day trading. Maybe you will get as a second job day trading. It's up to you, but at least you will know how to day trade, how to invest. And when you will see sometimes on CNBC or Bloomberg, or some investors or some advisors will try to advise you how to invest, you will know where is where is basically a person who never traded before, maybe trying to advise you how to trade. You will know exactly how to do. Okay, I'll speak to you later for our strategy. Like I said, go to our website and stay safe.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America. BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Good morning from New York City. With equity futures melting up to end a week ahead of a long weekend, I'm Lisa Abramowitz, in for Jonathan Farrow. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
begin with the big issue. Markets closing out the month with a sentiment boost.
Market sentiment is changing. People are recognizing the back half of this year is going to be very robust.
The expected explosion in U.S. data.
The potential for infrastructure spend. This renewed sentiment.
We're at $1 trillion floor right now. We're talking about going higher.
Republicans can't stop it. It's $2 trillion. Biden wants to spend much more.
That could be another catalyst.
A lot more stimulus.
A new renewed lift to sentiment.
You see the bond market react to these kind of budget negotiations.
A lot of opportunity.
Bond yields have kind of moved sideways for the last few weeks.
A month and a half of consolidation, trading sideways.
What it has to do with investor sentiment.
Perhaps we've already passed the point of peak anxiety.
That affects sentiment. Sentiment has a real impact on markets.
A lot of hope and a lot of proposals coming from Washington, D.C. Joining us now on the phone is Bloomberg White House correspondent Josh Wingrove. We are expecting, Josh, Joe Biden to release his spending plan, his budget, over the upcoming years at 1:30 p.m. today. What exactly do we expect him to say?
Well, this will be the first time that we really see them, jam together all their proposals so far and the discretionary spending. I think it'll obviously give a snapshot about the weight that all of this is putting on the debt and deficit trajectory in the U.S. But, broadly, he is trying to make the case that we need to fundamentally sort of reorient the U.S. economy more towards, for instance, workers. He wants wages to rise. He wants corporate taxes to rise. And this will be sort of one step in it. Of course, this is in some ways, in many ways, pretty ceremonial, right? This is reflecting stuff he wants, not necessarily stuff Congress will do. So we'll see on that. He's also, though, going to speak in a couple of hours about vaccinations, and that, of course, is the real key backdrop here. Biden is pressing to reopen and sort of spur growth in the economy, as well as sort of reorienting supply chains, that kind of thing. And the backdrop to that is that he is doing it and only really pivoting to it because job number one of his administration, vaccination, is starting to crest over that hill.
Josh, thank you so much. We know you've got a busy day ahead of you, and we appreciate you taking the time. There's also a question about higher taxes ahead. JP Morgan's Jamie Dimon taking questions in a second day of testimony on Capitol Hill yesterday. Here's an exchange with Michigan Representative Bill Huizenga.
What do you see as the greatest threat to our financial system right now, and to your company as well?
Public policy not being properly executed in the United States of America, which means we may not be able to take leadership role in the world for the rest of our lives.
Okay, what does that mean exactly?
I think we've done public policy not particularly well when it comes to infrastructure, immigration, healthcare, taxation, regulation. We've stifled the formation of small business. American leadership really matters. And if we don't get our academic act together, we won't be a leader in 20 years.
Okay.
Joining us now to discuss, Megan Green of the Harvard Kennedy School and Tom Tsitsouris of Strategas. Megan, I want to start with you. This concept that higher taxes leads to slower growth. Is that the case, or does the Biden administration have a point that if they spend it on infrastructure spending, on certain growth-generating initiatives, it could have the opposite effect?
Yeah, so it all depends, as you highlight, on exactly what the money is spent on. So if the money is spent on investing in infrastructure, investing in human capital, that can fundamentally boost growth. Also, it's worth considering that when we had the tax cuts a couple of years ago, there were expectations for greater investment, greater growth. We had a bit higher growth very temporarily, but 2 years down the line, there was no real sign of that. So if it didn't work that way the last time, why would the opposite be true now?
Tom, what's your take on this? I mean, how much do you look at these proposals and actually adjust your investment outlook based on them?
Well, I think it depends on what the eventual end result is on the tax policy. But let's just assume, the base case is we've raised marginal tax rates to 39.6%. We get corporate tax hike to 25%. There's probably not a lot of economic drag from that. If you raise instead corporate tax rates to 28%, you start to get a little bit more economic drag. But also the phenomenon that you've got to understand is likely to happen in 2022 and beyond is that corporations have pricing power and you have oligopolies in many industries. So tax increases and the associated costs that go with those tax increases are very likely to be pushed back onto the consumers who can least afford to pay it. So the economic drag will, in this case, trickle down to those who can least afford to pay it. And that's one of our concerns. And that's why we would echo Jamie Dimon's thoughts that probably the biggest risk to the U.S. economy is taxes.
Megan,
tax increases.
When you take a look at what's being proposed right now, does it excite you or does it concern you in terms of its productiveness?
Yeah, so first, I would say that, we have a major significant amount of market concentration in the U.S. in certain industries more than others, but I think that actually suggests that firms in the past have been looking more for trying to consolidate their market power rather than hiking prices. That's what we saw. Everybody thought we'd see much higher inflation off the back of tariffs, for example, and instead firms went ahead with forbearance instead. And we could well see that this time around with higher taxes. When it comes to what's on the table, actually, I'm really encouraged by the kinds of investment that the Biden folks are putting forward, both in the jobs and the families plan. But it's this, the U.S. is trying to figure out what kind of economy it wants to be when it grows up, I think. And it's trying to come up with a more inclusive, thoughtful form of capitalism. And the kind of infrastructure spending that they're talking about, we've desperately needed for years. And the kind of social programs, I think, really do invest in human capital and should fundamentally move us to a higher equilibrium, which I think should be the goal of policy in this case, coming off the back of a massive crisis.
Tom, do you think that this proposal gets us closer to moving off this very ultra low rate environment that we've been in?
Well, I certainly think the infrastructure spending does. I think both sides of the aisle would argue that infrastructure is sorely needed as a new investment, both for the jobs it creates, but also for the productivity it unlocks. I absolutely agree with that. But I would also argue, I think the U.S. economy has actually already attained the escape velocity that we so desperately craved last decade. So with that said, I'd be very cautious about how I would try to interfere with that to either enhance it or slow it, because I think we've got it right now. And as many of the speakers earlier in the week were suggesting, there is an enormous amount of stimulus and growth pent up for the back half of this year. And that itself is going to give us a lot of trajectory and inertia. So I would be cautious about tinkering with that right now when it looks like we finally have that escape velocity.
Well, certainly there's a lot of uncertainty out there, and yet yields on the U.S. 10-year are basically stuck in neutral. They have been for most of the month, basically flat on the day, even after higher than expected PCE readings. BlackRock's Russ Kosterich weighed in.
Even in these days, when the market is down a couple percent, the way it was last week, either bonds are flat or they're up a little bit. They're not giving you that big movement that made them such an efficient hedge the way they were a couple of years ago, and that's a big change. If you're building a portfolio, the degradation and efficacy of bonds as your primary hedge is a big deal.
For more, let's get to Bloomberg's Kaylee Lines. Kaylee.
Lisa, I'm just going to be blunt. The month of May has been incredibly boring for the bond market. You know where we've gone on the U.S. 10-year yield over the month? Absolutely nowhere. Flat on the month at 1.6, just shy of 1.61%. That's because, yes, we've seen break-evens tick up marginally about 2 basis points, but we've seen real yields tick lower by 2 basis points. So what do we get? Those canceling each other out. And where that leaves us is really just stuck in this range where we've been for about 2 months now. After the 10-year yield topped out at about 1 3/4% at the end of March, we've been trading in between 160, 170 really ever since. So we've plateaued after what was a monster move in the first quarter, with yields moving higher by about 82 basis points. And of course, yes, Lisa, 1.6% is higher relative to where we started the year, no doubt about it, but it isn't high relative to history. And that doesn't make treasuries all that attractive for a portfolio either. When you look at the ratio, the correlation between S&P 500 futures and 10-year treasury futures, it is at the highest since 1999. We are talking more than 2 decades. So if you're trying to hedge within a portfolio, Lisa, bonds are just not doing a very good job of doing that.
Yeah, and this has been a serious issue, especially for the 60-40 portfolio. And there is a question going forward of why bonds have been so stable. Tom, I want you to weigh in here because we got this higher than expected inflation reading, the PCE deflator, the key metric that the Fed looks at. Bonds are doing nothing. How do you make sense of that?
Yeah, well, there are technical reasons for this, and there are fundamentals. The technicals are pretty quick. essentially, when you have stability in bond yields for an extended period of time, you actually get a positive feedback loop because volatility chasing strategies just continue to add leverage and they lever up their bond positions. And really, that's why you start to get positive correlations between bonds and equities, because they basically buy everything they can when volatility declines. The fundamental forces, well, those are a little bit more important. What you see right now is very similar to what we saw in 2012 and 2013, the second half, where right now what's happening is you've got the inflationary fears which are trying to pull bond yields higher, and you have the concerns that tax policy is going to come in on too much on the hawkish side and the restrictive side, and that's basically creating a stability. We saw the same thing in 2012, 2013, when the bond market was grappling with what could be a very large fiscal cliff in 2013. And so you saw 10-year yields get stuck between about a 140 and a 180. Well, we're doing the same exact thing right now. The market is kind of tussling and wrestling back and forth with how big are these tax increases going to be. And if they're large enough, they could completely offset the escape velocity that I mentioned earlier and therefore suppress the inflation pressures. So for now, you have balance, and that balance itself is beginning to draw leverage back into the market, both equities and treasuries.
On an economic level, Megan, Emily Rowland of John Hancock commented that it could be that the reflation narrative really is priced into the market already fully. And that is what we're seeing from the muted reaction, the almost non-reaction in markets from this higher than expected reading. Do you think that that's a step too far, or do you agree with her?
So I think that could be the case, but I would read 10-year yields a little bit differently and suggest that investors just aren't that worried about a sustained massive rise in inflation. And if you looked at the wage and salary data today, for example, it showed a 1% increase in both April and March. That's hardly the kind of wage spiral that some people are really worried about. The data is just not supporting it yet. And also, if you consider how much the U.S. is actually importing, a lot of inflationary pressures are going to leak out of the U.S. Economy. And so I think investors are also saying, the 10-year yield reflects the view that actually we should have higher inflation for a little while, but we probably don't need to worry that much about it in the medium to long term.
Megan, what would you have to see to revise the vision that the market certainly believes, which is that this is transitory?
I think we would need to see much higher inflation. I think it would need to be more broadly based. And I think we would need to see inflation everywhere else globally. It's really hard for one country or one region to have breakaway inflation and actually sustain it. So we should get higher inflation in Europe and the UK, for example, but it would need to be much more broadly based globally in order for it to be sustained. That being said, look, I'm not worried about inflation in the medium to long term, but if we get to the end of this year and have inflation of 3% and unemployment of 4.5%, I do think that the Fed's narrative that the appropriate policy rate should be zero gets increasingly difficult and untenable. So I think they should look through it as they are doing, but it'll be more difficult for them to do that.
Megan Green and Tom Tsouras are both sticking with us right now. Bloomberg's Abigail Doolittle joining us with a look at the stocks moving ahead of the opening bell. Abigail.
Lisa, well, we do have the S&P 500 futures up for a third day in a row. If those gains hold into the close, it will be the first time we'll have seen that in nearly a month. So that's another way of saying the bulls are out. Modest gains helping Salesforce.com. Shares of CRM are higher after the company put up a very solid quarter. Big adjusted earnings beat, a smaller sales beat. The forecast is topping profit estimates. And it's very important because they are rebuilding investor confidence after a challenging quarter about 6 months ago. HP, on the other hand, down this after they beat, but they're falling on concerns that PC demand may have peaked. And then the space that just continues to give to the bulls, Lisa, of course, the meme mania. AMC Entertainment up once again, up 19%, now a double on the week. GameStop up modestly. And apparently the new meme stock, the new Reddit stock, perhaps Beyond Meat, up 7.3% this morning, certainly acting that way, Lisa.
Yeah, everything is a meme stock, as we were talking about earlier this morning on Bloomberg Surveillance. Coming up, that inflation data we were just talking about, surprising to the upside yet again, adding further fuel to the debate over transitory. We'll discuss that more up next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
The fear of the 70s, the 80s, the stagflation, it is such a different world. They're prepared to wait longer because they're more confident that we have stable inflation expectations. We have a much more flexible set of pricing. We have less of that generalized inflation.
Global central bankers following the Fed's lead in tempering inflation fears. The Bank of Japan backing Chairman Powell's lower for longer narrative.
This policy stance is based on the recognition that it will take time to overcome low inflation once it is entrenched. As you know, this is also a lesson learned from Japan's experience of prolonged deflation.
This as Dallas Fed President Robert Kaplan doubles down on his call for a reduction in policy support amid looming inflation uncertainty, saying, quote, it would be wise sooner rather than later to begin gently taking our foot off the accelerator so we can avoid and reduce the probability of having to apply the brakes down the road. For more, let's bring in Bloomberg's international economics and policy correspondent Michael McKee. This concern about having to raise rates more quickly later on, Mike.
Well, those who are watching inflation got some more of it today, Lisa. We are seeing numbers that we haven't seen in quite some time. The income and spending numbers come in pretty much as expected. We knew that incomes were going to fall because we had seen transfer payments, the stimmy checks, go up 570% in March. They're down by 70% this month. Spending held in 0.5%. We knew it would drop, but it did hold in. But the numbers everybody's looking at, of course, are the PCE numbers. The core PCE, 1.8% last month, up to 3.1%. That is the highest since 1992. So that's going to get a lot of people's attentions. Now, the issue is, as you go forward, do you have wage inflation? And in this case, we don't. Wages and salaries just up 1% during the month, and that's the same as it was the prior month. So maybe it's too early for all those companies that raise wages to get that into the data, but we're going to be watching that as well. One thing we've been talking about, of course, is inflation expectations, and they've been rising. And the same thing is true with the term premium now, which is essentially the greater risk of holding on to your investments for longer. And after a long period, as you can see, where nothing changed, now all of a sudden the 10-year term premium has gone up, and people are becoming more concerned about the longer term. It isn't just inflation. It's whatever else risks are out there, but that's obviously built into it, and it's something to keep an eye on.
Indeed, and in 40 minutes' time, we're going to be getting that Michigan consumer sentiment reading. Mike, how informative are the consumer sentiment, the consumer belief in inflation when it comes to predicting longer-term inflation?
Well, we haven't had that in a long time where the consumer numbers mattered a lot. Back in the 1970s, the idea of inflation got entrenched, and then everybody went out and asked for raises, and that started that wage price spiral. So we'll see. We have seen in the previous numbers that consumer expectations have gone up, but only in the short run. In the longer run, they've remained contained. If that longer run number starts going up, then there's something to keep an eye on.
Thank you so much, Michael McKee, Harvard's Megan Green, and Tom Tsouras of Strategas still with us. Megan, I want to start with you. When you take a look at some of these numbers, what gives you confidence that there isn't this entrenched inflationary push that we haven't seen since the early 1990s, if not before?
Yeah, so I think the wages and salaries data suggests that we're not getting a wage spiral, and that makes sense given everything we know about worker power and how much it has decreased over the past couple of decades. So I think it would be really difficult to actually get a wage spiral now, given how weak worker power is. Also, I think trying to figure out pricing power for companies is important, and seeing whether they will actually pass through higher wages if they end up paying them to the end user, and that would feed through into inflation. But again, we haven't seen that in a while, in part because of market concentration, and that just got worse over the pandemic, not better. So I'm not too worried about that. And then I would also look at data that has nothing to do directly with the inflation data, but our import data. As I mentioned before, we're importing a ton of goods and services. And so if you're using that stimulus check to buy something in your neighborhood, then that could be inflationary. If you're using it to buy something that you've imported from elsewhere, that's not going to be very inflationary for the US economy at all.
Tom, what would you have to say to change the view that currently is held by markets?
Well, I'd say it's going to be simply put, data, data, data. In its simplest sense, from a mathematical standpoint, you need at least 3 data points to confirm a nonlinear trend. So that tells us that if we're looking at, for example, that core PCE number, quarter over quarter, which came in at 2.5% for the first quarter, you need essentially 3 quarters at those levels to give us some sort of confidence that you're seeing a nonlinear trend emerge. So we're going to need more data. And the earliest we'll get that data, or enough data to give us more confidence in that, is probably August. So the bond market's going to have to deal with what appears to be, for the time being, transitory inflation. And then as the data evolves, the bond market will make up its own mind. But I'll tell you this, if I were looking ahead to the summer months and the fall, the things I'd be keeping my eye on for leading indicators that would make me worried about not necessarily accelerating inflation, but sticky inflation. So it's somewhere between transitory and accelerating, sticky inflation. The things I'd be looking at for my kind of inflationary checklist are housing market, strong, that's an inflation amplifier. Municipal spending, likely to rise. Federal government spending, also inflation amplifiers. Dollar weakness, also an inflation amplifier, and we do expect further dollar weakness this year. Energy prices moving higher, also an inflation amplifier. The one missing piece is, do households, do laborers believe they have pricing power? Businesses believe they have pricing power right now. If households do, then you've got your full inflation checklist.
Tom Tsouras and Megan Green, thank you both so much, and have a wonderful long weekend ahead. Coming up on the morning calls and later, closing out a month that was all about the reflation trade. That conversation still ahead. We are looking at a melt up to end the week. This is Bloomberg.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. For Brutus.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. We have a melt up to end the week. People like what they see in the inflation data, and we have seen that reflation trade continue. Time now for a morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, Barclays downgrading Kansas City Southern to underweight. The analyst seeing headwinds from its merger agreement with Canadian National. Next up, Benchmark initiating coverage on Intel with a buy rating. The analyst seeing market share gains at the expense of Intel. And finally, New Street Research downgrading Apple to a sell with a street low $90 price target. The analyst seeing a weaker outlook for iPhone following last year's robust demand. Coming up, tech stocks heading for their worst monthly performance since October. That conversation coming up next with UBS's Stuart Kaiser and Schwab's Colin Martin. This is Bloomberg.
Bloomberg Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg, the Open. Lisa Abramowitz in for Jonathan Ferro, just seconds away from the opening bell. We can see that melt up continuing, ending the week that has really been marked by reflation, people going back into the cyclicals, deciding that, yes, we are going to get that growth, but perhaps it isn't going to lead to that kind of inflation. If you take a look at what we're seeing in bonds, it is boring, boring, boring. The stability just absolutely driving people to bet out any potential increase in price action going forward. You could see unchanged yet again. Crude gaining a little, 0.4%, and the euro actually a little bit weaker after some market strength as the dollar had been weakening earlier in this week. Meanwhile, let's head to markets desk. Bloomberg's Abigail Doolittle parsing through the action. The stocks moving at the open, Abigail.
Well, Lisa, let's start out with a story that is capturing everyone's attention. Last week, it was Bitcoin in the crypto space. That is still a deal to take a look at, and we will be in a moment. But the meme stocks are really on fire once again. AMC up another 20% alone this morning. That after gaining about 90% Monday through Thursday. So the short squeeze, the gamma squeeze, whatever you want to call it, you have those Reddit traders out taking these stocks higher, including Express and GameStop. As for Johnson & Johnson, shares are modestly higher. This, of course, after the UK has approved its one-shot vaccine for COVID-19. And then turning to the Bitcoin space, Lisa, a wild ride continues because today, of course, we have the crypto space down, Bitcoin and Ethereum both down about 5%, and you can see some of the related stocks going in that direction. It's hard to know what will happen in this space, though. Up 10% one day, down 5% one day. Here we are on the down day. What will the weekend bring? Who knows? It's a long weekend, Lisa. Some of those traders might be bored and really send these crypto currencies even in more wild direction.
I do wonder if any of these Bitcoin traders actually look at what the Bank of Japan, as Kuroda, has to say, or frankly, even Janet Yellen. Meanwhile, the reflation trade strengthening its grip on markets this month. The NASDAQ heading for its worst monthly performance in 7 months. For more, let's get to Bloomberg's Kaylee Lyons. Kaylee.
Yeah, that reflation theme super evident in the equity markets this month, Lisa. Really easy way to look at that is just look at the sector performance when you look beneath the surface of some of the benchmarks. In the Russell 1000, your top performers on the month, materials up 6.4%, followed by energy and financials, aka your cyclical plays. On the bottom, your more expensive and more defensive areas, tech lower, utilities, and discretionary, which of course is where Amazon and Tesla lives. As you said, the NASDAQ and the S&P 500 tech index both heading toward their worst months since October. And another key indicator that it has been a reflationary tone is the fact that smaller stocks have outperformed larger ones. When you reverse the market cap weighting within the S&P 500, makes smaller stocks more important, it has outperformed, up nearly 3% on the month. The regular market weighted S&P 500 is up less than 1%. I will, though, just end on a word of caution, Lisa, and thank you to Laura Cooper, one of our columnists on the MLive blog, for this one. Beware of the zombies, because the risk of zombie companies seems to have died down recently amid all of this reflation optimism, but it is still there. And we can see that U.S. companies that have weaker balance sheets, are overly indebted, have been outperforming their strong balance sheet peers, not just this month, but really for the entire quarter. And as Laura Cooper says, this train raises a question about the sustainability of the reflation trade, Lisa.
I love that you're talking about zombies. It is a big concern as low interest rates drive people and frankly, companies to borrow an incredible amount of debt. Joining us now is Stuart Kaiser of UBS and Schwab's Colin Martin. Stuart, I want to start with you and start with this sort of big tech sell-off that's been picking up steam. I'm wondering if it makes sense to you that it should underperform going forward, or if perhaps people are throwing it out with the bathwater, basically saying, you know, yeah, it's overpriced, but they aren't considering their potential earnings.
Yeah, hi, good morning, Lisa. You know, the sell-off, I think, in tech has actually been quite interesting from a timing perspective, honestly, because the first 2 weeks of the month when we had the U.S. data and the inflation print, tech was under a lot of pressure. But frankly, since then, once that inflation data got digested, you know, parts of the tech space have actually rallied pretty well. You know, semis has come off the bottom, XLK has rallied a bit, and NASDAQ has kind of found its footing a bit. You know, the bigger question I think you ask is, you know, rate sensitivity, inflation sensitivity of the tech sector. And there, I think, again, it's a tale of what exactly you look at. You know, large cap tech, which is strong balance sheet, high quality, cash rich, and dividend paying, you might argue shouldn't be as sensitive to moves in rates as I think it's traded. Whereas the, you know, smaller tech stocks with, you know, exceptionally high valuations seems to be the area that's a little more impacted. So I think a lot of clients are looking at things of, NASDAQ 100 against ARK as like a relative trade, for instance. Try to sort of tease out the difference between these large cap tech winners and the smaller tech sort of hopeful stocks. So, to our view had been trade U.S. cyclicals into the U.S. data. Once that data got digested, actually get long tech for a couple weeks, into month end. And now I think we're probably ready for a little bit of a repeat of what we saw at the beginning of the month.
Which raises a question, though, this idea of the dynamism of the U.S. economy that a lot of people are betting on, whether this will lead eventually to higher inflation. In other words, is it sustainable to be getting the kinds of returns that we're getting in equities without some sort of increase in yields? Colin, what's your take on that?
Well, we think we can see strong growth as the consumers remain really strong right now. But on the inflation front, we're on board with the transitory theme. But we do caution that we don't think once the levels come down a little bit, we don't anticipate them going back down to those sub 2% levels that we witnessed over the past decade or so. We've had so much fiscal stimulus out there and potentially more expected with policies from the current administration that once the dust settles, maybe inflation settles in that 2 to 2.5% area, which is probably what the Fed's looking for. But in the short run, we're not too concerned with these high numbers we've seen lately. We do think that this month and the next few months are likely to remain transitory.
So there's a question then, Stuart, when it comes to equities. You talk about the relationship between low rates and tech investments, and then the reversal of that. What is this most underpriced sector that is potentially sensitive to rates that you're looking at that could potentially be disrupted if we do get that higher rate regime?
It's a good question. The higher rate stuff, I think it's, as Colin, I think, described, there's a little bit of a double-edged sword here. It's if rates are moving higher because of growth, good thing. Rates are moving higher because of inflation, potentially that's more of an issue. What the market is telling you is you need to be worried about tech because that's how it's sort of traded. As I said earlier, I think our view is you need to kind of overlap a couple of these things. You need to maybe look into the tech and the more expensive part of the markets, but then sort of, find the lower quality parts of that or the higher valuation parts of that, because I think it's just going to be a little more nuanced in terms of how the market trades this on a go-forward basis. I think, our view has been if you want to get quote unquote long inflation, you're doing that through the obvious candidates, which is, energy, metals, and mining and banks. If you want to hedge it, you're frankly playing around in some of the consumer staples parts of the area of the market, and then obviously focused on tech as well.
In the meantime, we also are looking at meme stocks, the big tech names not yet considered meme stock, but Bloomberg's Abigail Doolittle is taking a closer look at some of these meme stocks that are back on the move.
They are back on the move, Lisa. It's really pretty incredible. AMC on the open now up about 18%, a market cap of $16 billion. Really pretty incredible on the week, up 184%. Not surprisingly, that's the best week since late January. You can also see very nice gains on the week, incredible gains, frankly, for GameStop, Express, Costcorp, some of the other big meme stocks up this week. The best weeks for those stocks since March. Now, what's behind this? It's not entirely clear. Just perhaps these traders, these meme stock traders and Reddit board traders wanting to make a buck. AMC, of course, has that reopening play, though, as well as folks get back out there, perhaps into the movie theater. However, for the Bitcoin space, not so much. We go into the Bloomberg terminal and take a look at what's happening for Bitcoin. It is the worst month on pace for the world.